What a week we've got coming up for you. 5 of the Magnificent 7 reporting on Tuesday, Thursday, the Federal Reserve on Wednesday, payrolls on Friday. We begin this morning with breaking news over the weekend. Bramo, we've got to go straight to it. A big re-evaluation of risk in the Middle East.
3 U.S. troops were killed on the border of Jordan, and this is a true escalation. That's what all of the notes are saying. 34 injured on that particular base, including critical brain injuries, which is a deep concern not only for now, but also for later. Now the question is, how does the U.S. respond to something that quite clearly does materially shift the calculus for how much the U.S. gets involved in this war?
Anne-Marie, foreign policy hawks in Congress straight away immediately over the weekend saying hit Iran hard, hit them now. That's the message from Senator Graham and others.
Yeah, absolutely. Republicans are going after this administration to take a more strong approach when it comes to the Middle East. Directly, they want attacks on Iran. But this administration has for months been saying they do not want to see an escalation in the Middle East. Will this attack on these 3 service members and dozens wounded in Jordan, is this a new red line for this administration? And are they going to have to take a stronger approach, not deterrence, an actual attack?
Let's try and take the temperature of things right now in financial markets. Things are pretty calm, Barrett. If you look at what's happening in the commodity market, crude's totally unchanged on WTI. WTI right now on my screen at about $78 a barrel.
This feels like boiling a frog. That was what I thought about all weekend. The idea that there's one tit for tat and then another and another, and any one of them could be escalation, but a lot of people are just shrugging it all off and saying, you know what, it hasn't been a problem until now, it hasn't disrupted oil flows, it hasn't disrupted trade except for jacking up the prices, maybe to Europe, but more broadly, it hasn't created some sort of existential crisis with supply chain disruptions, so we're going to ignore it. How long can that kind of complacency continue? And that was in every single note that I read over the weekend.
There's 2 potential ways that this can go currently. AMH, 1, you can go hard on Iran, or 2, you can push Israel to push back, or rather pull back out of Gaza. They are the decisions that this administration's got to make in the coming weeks and days.
Right, but Biden put out a statement, and the last sentence of that statement was, have no doubt we will hold all those responsible to account at a time and a manner of our choosing. There will be a response, but to your point, what level is this response going to look like? And we should note, to your other point about if they want Israel to back off in Gaza, there are peace talks happening as well over the weekend, and that will continue into the week between potential ceasefire with Israel and Gaza.
I mentioned things were pretty calm. They are in the equity market as well. Look at the S&P 500. Equity futures shaping up as follows on the S&P. We are positive by 0.03%. In the bond market, yields are a little bit lower. We're down 4 basis points to 4.095%. Coming up on the program this hour, Terry Haynes of Pangea Policy on President Biden facing pressure to confront Iran. Sophie Lunge-Yates of Hargreaves Lansdown looking ahead to the week's big earnings. And Mizuho's Don Constant on the Fed's path forward and why he thinks this S&P 500 could break below 4K. That story a little bit later. We begin with our top story, escalating risk in the Middle East. The White House confirming 3 U.S. soldiers were killed and at least 34 were injured after a drone attack in Jordan over the weekend. Iran's foreign minister denied the country's involvement. U.S. and allied forces saying Iran-backed militants are to blame. The president vowing to retaliate, quote, have no doubt. We will hold all those responsible to account at a time and in a manner of our choosing. Terry Haynes of Pangea Policy joins us right now. Terry, good morning to you, sir. Let's get straight to it. The events of the weekend, how does that change foreign policy for this White House?
I think it changes it incrementally, but not in a major way. It's important to say what this isn't and then what it is. Firstly, what it isn't World War III, as some presidential candidates have it. It's not going to be a strike on Tehran, as some senators would like. I think what you'll see from the White House is a continued proportional response, but they've got to thread the needle pretty carefully. They're going to want to have a strike that is devastating, that is a strong response, but at the same time threads the needle to make it clear that there's not going to be a huge escalation. That's going to be a difficult challenge. So I think they'll probably take a little bit of time. I would also note that Biden's time and places of our choosing is more or less the standard language. And one thing that probably means diplomatically is to expect a more or less standardized response from the White House.
How cohesive, Terry, is the approach from this White House? And I ask this at a time when there have been more than 150 attacks on U.S. soldiers in Iraq, in Syria, since October 17th, with a lot of people wondering whether the U.S. is just going to pull some of these troops out, given that they're kind of not sitting ducks, but really in the line of fire. How much has the administration really talked about that?
Well, the administration hasn't talked very much about that, but I think it implies a couple of things. One, to pull troops out at this particular point would imply weakness, which is the last thing the White House wants to do, particularly because it's stepping up attacks to try to defend the Red Sea corridor. The other thing that I think it means is that, you know, you've had a United States response or United States presence in the region for a very long time, and to pull troops out at this point would send a very bad message about the nature of the United States commitment to countries that are allied with us in the region. I'll include not only Saudi Arabia, but independently and importantly, Jordan here. And I would look for Jordan's response to be a good bellwether, but that it is an independent country with its own independent interests, and the United States is going to have to continue to engage it carefully to make sure that whatever the United States does, that Jordanian interests are not unduly pressured as well.
Terry, Lisa mentions these 160 attacks service members have been under, whether it's Iraq or Syria, but now we have 3 service members dead and dozens other wounded. Will Washington view this as a new red line?
I think that's a very good question. I think the answer very likely is no. I think it probably increases the force of United States response. I do not think that it creates a situation where the United States is in a war or in a conflict to a greater extent than it now is, by and large.
You've worked a lot in Congress and been a liaison as well between congressional lawmakers and the White House. You see Republicans pushing Biden to attack Iran directly. Would he need to go to Congress for that type of approval?
He will say no, and you know, Congress will say yes. And usually the interpretation of the War Powers Act varies depending on whoever party is in the White House, whoever party is in Congress. Congress, what'll end up happening is that Biden will take an action, inform Congress quickly, but in its own time. Elements in Congress will complain, and the world will go on as before.
Terry, as you know, the former president would say if he was still in power, this wouldn't have happened. Terry, how has Iran changed over the last few years? And what kind of Iran would the former president have to confront if he did indeed come back into power?
Well, you've got two kinds of issues here, John. And I want to get to the second one. I think is unappreciated in markets. I wrote about it yesterday and want to comment on it. One is that you've got an Iran that not only has these variety of these proxy networks, but now is interested in deploying them, using them, very aggressively to try to make its points and its conflicts with both the United States and with Arab countries that are Western allied as well. Secondly, and I think the point that people don't appreciate is that we are now up against more warnings about the potential for Iranian nuclear capability. Again, I wrote about this a little bit on Sunday, but the idea is that Iran's going to have the ability to have nuclear weaponry, perhaps as soon as 2024, and there are a number of credible people in Washington and elsewhere that are warning about that. So, the administration is going to have to thread a needle here, not only in terms of the Iran and the proxies, and Biden was very careful to blame proxies for this, but also the looming question of Iranian nuclear capability, which could put it into a different category among nations.
Well, the International Atomic Energy Agency director joined us in Davos and told our colleagues that Iran is at a level now where they can build and generate these atomic warheads. What is the Biden policy to 60% enriched uranium under this Iranian regime? And
your interview was one of the sources that I cited on that. The policy is that they don't want it to go above that, but the reality is they're powerless to stop that. That can be seen as a failure of Biden policy. It can also, to John's question, also be seen as a failure of Trump policy, since Trump was the one who decided to not negotiate with Iran anymore. But regardless of the blame game, what you have is a muddled United States policy for about the last 10 years with Iran. And the priority has to be not only on figuring out the immediate response here, but also kind of right-sizing U.S. policy with Iran and engaging our allies and friends in the region in creative and, again, individual sort of ways, not treating them as a monolithic bloc, but individually, to see how we can best push back and best shore up our interests and those of our allies in the region.
Hey, Terry, great to catch up as always. Terry Haynes there of Pangea Policy. AMH, that last point, I think is so important. The Iran of 4 years ago is very different to the Iran of today.
Yeah, absolutely, because now you have Iran enriching uranium at 60%. This is weapons grade. This is a massive concern for the Biden administration. But the Biden administration also, when they came in, actually took away the Iran Mission Center at the CIA and made that part of a more regional, cohesive desk at the CIA. And some say that was a mistake. There should have been a select group of people that just focus on Tehran.
Things felt really unsettling over the weekend. I have to say, no drama in the equity market at the moment. Equity futures basically unchanged on the S&P 500. In the commodity market, big rally last week, higher by more than 6%. WTI this morning, just about positive by 1/4%, $78.20 on crude. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahira Hackers. Hey, Yahira.
Hi, John. Oil's on the move following escalating tensions in the Middle East. A tanker carrying Russian fuel was struck by a missile as it left the Red Sea on Friday in the most significant attack yet by Houthi rebels on an oil-carrying vessel. Meanwhile, the U.S. says 3 service members were killed and 34 wounded in a strike on a U.S. base in Jordan by Iranian-backed militia over the weekend. Tehran has sought to distance itself from the attack. Shares in China's Evergrande plunged 21% and then were halted in Hong Kong trading following a liquidation order from a Hong Kong court. The judge saying the property developer will be taken over by new management in order to carve up $300 billion in liabilities. As of Friday, Evergrande's dollar notes traded at just 1.5 cents on the dollar. The Chiefs and 49ers are set to meet at this year's Super Bowl. Kansas City aims to be the first NFL repeat champions in almost 2 decades. It's not clear whether Taylor Swift will be there to support her boyfriend, Chiefs tight end Travis Kelce, as her tour schedule has her in Tokyo through February 10th, the day before the Super Bowl. And that's your Bloomberg Brief. John?
Yahira, thank you. So you do the constant a little bit earlier, get over from Tokyo to Vegas.
Are you ready for it? It's a Taylor Swift reference.
Is that right? Okay.
Swifties will know. Okay. I think she'll have to go. I mean, for the NFL, they should want her there. I have friends who do not care at all about football, and now on the weekend are like, I need to find a bar to go watch the Chiefs game.
The Taylor Swift game, specifically, not the Chiefs game.
I mean, honestly, this to me is the most hilarious point. There was actually an entire article written about how they showed Taylor Swift less last night than they had in the past, and that was controversial for all the people who were just watching the show for her. Either way, there's sort of, I've got to feel the heartbreak for the Detroit Lions because they really did lose a game that they were poised to win. And then on the other hand, we've seen this movie before, and the Chiefs won. I don't know, Kelce and Mahomes, are they going to come and then Taylor Swift comes and it's going to be,
Beautiful thing.
Yeah.
She can make it.
Great for advertisers worldwide. I bumped into Michael Barr in the newsroom. Very, very depressed.
I was going to say.
About that second half. I went to bed, it seemed okay. And then it turned around in the wrong direction for him. Up next on this program, a pivotal week on deck.
The Fed has been very clear in terms of its forward guidance, and the market's saying, yeah, sure, but I'm not going to listen to you. That's really problematic.
That's coming up next on the program. You're watching Bloomberg Surveillance live from New York City this morning. Good morning.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Live from New York City, 3 weeks of gains on the S&P 500. Equities right now just about positive by 0.03%. Yields a little bit lower, down by 3 or 4 basis points, 4.1%. Tension in the Middle East. It's not showing up in crude this morning. Positive by 0.25%. $78.21 on WTI. Brent crude 83.80, up by 0.25% there as well. Under surveillance this morning, a pivotal week on deck.
The Fed has been very clear in terms of its forward guidance, and the market's saying, yeah, sure, but I'm not going to listen to you. That's really problematic.
When's that first rate cut coming, Mohammed?
Call it June, maybe July, and it will be 25 basis points.
Investors hoping for clues on the Fed's rate cut timeline on Wednesday's meeting in the news conference with Chairman Powell. The decision sandwiched between a slew of events, including Microsoft and Alphabet earnings tomorrow, Apple, Amazon, and Meta on Thursday, payrolls on Friday. Weighing in on all of this, Sophie Lund-Yates of Hargreaves Lansdown. Sophie, what a week ahead we've got. Let's kick it off with the tech earnings. Can big tech keep carrying this equity market on its back?
Hi there. To be honest, yes, I think they can. I don't think we're going to be without challenges. And the flip side to that is I do think we're in a situation where there are a few more nerves in the market. So I do think any misses are going to be probably more punished than they are usually. But that said, I think that the fundamentals for a lot of these names, particularly the likes of Microsoft, are actually still incredibly strong. So I am actually going to this with some pretty broad optimism. So let's see how that pans out.
A lot of people disagree. I will just say I heard a lot of pessimism in some of the notes. Jonathan Krinsky over at BTAG noting that the SPX has gained at 12 of the last 13 weeks. The last time that happened was in 1985. Clearly, upside momentum is strong, but it's starting to show some exhaustion signals here. How much are you pushing back against that? Are you actually aggressively buying into sort of a pause as people reassess ahead of this really pivotal week?
Yeah, so I think there's a couple of ways to look at this. I don't necessarily think that we're going to see like this gangbusters, huge increases necessarily off the back of these earnings. I do think there's a little bit of fatigue, you know, you're hinting there at that kind of exhaustion wording. But I do think that fundamentally the strengths of these companies is still going to be pretty robust. Now I will just caveat that with more so than usual. I mean, the outlook statement's always important, right? But it's even more so at the moment. And particularly for me, we know that obviously cloud AI is going to be the thing that's moving the dial. But what is kind of an unknown at the moment is the rate at which corporations are going to be reopening their purse strings. And that obviously has huge implications for those cloud players. But fundamentally, I do think that the demand there and the margins that they therefore underpin, those fundamentals still remain in play, in my opinion.
So what do you think is the most important of the events this week? Do you think that it's earnings, given your pretty sanguine outlook, or do you think it's the Fed or the economic data?
Equally both, I think. Now, really, when we look ahead to the Fed, now as much as things are broadly moving in the right direction, you know, we look at the inflation information we got on Friday, that preferred measure, you know, things are moving in the right direction. But I don't think we're in a situation where we're going to be seeing a pivot, unfortunately, which I think is what the market is probably been broadly expecting. So I think that the Fed is probably going to remain on a pause, and I think there could be some upset there, unfortunately. But the outlook, of course, still of course relevant. But I think it's going to be that Wednesday slate.
Sophie, let's talk about how challenged the dual mandate of the Federal Reserve is right now. Clearly some encouraging news on the inflation side of things. Can we talk about payrolls a little bit more? We have some people come on the programme who point out some weakness beneath the surface in the labour market report. The breadth of labour market gains have narrowed over the last, say, 6 months or so. Sophie, do you identify the same thing? And are you expecting to see that weakness come to the surface anytime soon?
Not really. I think that things might be coming off the boil in some respect, but I don't think that we're going to be seeing this kind of broad-based weakness that obviously policymakers are looking for. I don't think we're there yet, particularly when we start looking at some of the consumer data that's coming around as well. That obviously needs to be read in tandem with those figures. Broadly speaking, I think, unfortunately, this macro print, including things like the job reports, is still going to be supportive of the fact that we are not ready for a pivot just yet.
What's your view, your interpretation of the Fed's approach to all of this? Do you think this is something the Fed tries to get in front of or waits to see?
I think we're in a wait-and-see approach at the moment because, as I said, things are absolutely moving in the right direction, but they're in this kind of circling pattern. They need to see how much heat's coming out of the economy in the current state of play, and the answer is it's not enough. So they are waiting and seeing, which I think is the prudent and correct way to be doing this. We cannot be going too fast too soon because we're going to reverse a lot of the stability that we've seen. They have this really kind of narrow landing strip in which to land the economy, and at the moment they seem to be doing the right job between cooling things down a little bit without triggering a very hard landing. That's a really hard thing to do, and to keep that on the course, they need to kind of keep this kind of observatory going, as it were.
I've got to say, it's kind of purgatory, and people are trying to sort of assess which way it's going to turn, but it feels like purgatory, and I love some of the acronyms people are coming up with to try to make purgatory sound more fun. Max Kettner over at HSBC this morning talking about RORO and YOLO. RORO is risk on, risk off, and YOLO is you only live once, and basically why we're not going to get either of them, and we're going to live in this sort of reverse Goldilocks. How do you sort of characterize where we are and how you maneuver at a time with such bifurcated risk and such lack of clarity?
Yeah, sure. It's certainly a lot of uncertainty. And as I know, I've kind of beaten this drum on this show a few times. I think it's so incredibly important that investors remember that more so than ever, it's a time to remember the basics. So this is things like making sure diversification is where it needs to be, because value metrics, I think, are being slightly left by the wayside in a lot of situations. So, for example, I think Europe valuations are looking relatively compelling, and that's kind of the forgotten region at the moment. So it's remembering the basics and not being overly exposed to certain risks or certain areas of the globe, for example. But in terms of navigating volatility, yeah, it's making sure that you have that broad base of assets, you're diversified, and also you're not getting hung up on moonshots. If you want to invest in game-changing trends like AI, that's fine, but go about it with a company that's also got a proven track record of fundamentals and, my personal favorite, cash flow. Please don't forget that.
When you talk about European equities, this is something that we keep hearing. How concerned are you? We were opening the show with the geopolitical risk, and that has a much greater impact on European inflows, in particular in inflation regards to the Red Sea and shipments from there. How closely are you paying attention to that as a potential black swan event that really upends that trade?
Sure, I mean, it's incredibly important. And also, let's not forget that, there's a lot of big oil players in Europe as well. So the volatility there is very much, it's intrinsically linked to this oil price ups and downs that we're seeing. So definitely, I think there are bumps in the road ahead, and we can't say for certain what the very short term is going to look like. But longer term, valuation-wise, it's looking quite compelling. And also, I would just say that there are some very kind of strong businesses, particularly. They're not particularly the most fun. There's a lot of kind of very broad economic moats in the European region. I'm talking about things like telecoms, defense, names of that nature. That said, of course, the inflation landscape is a tricky one. So that's short term. I'm not saying there aren't going to be bumps, but longer term picture, I think, could be quite interesting.
Hey, Sophie, great to hear from you. Sophie Lund-Yates there of Hargreaves Lansdown on a big week ahead. Tons of earnings Tuesday, Thursday, Federal Reserve Wednesday, payrolls on Friday. Where to begin? Let's begin with tech. It's felt like for much of the last 12 months, the only thing that has worked is maybe US tech and some Japanese equities. Wall Street Journal over the weekend writing, the S&P 500, Lisa, is back at record levels for the first time in 2 years. Information technology is the only one of the index's 11 sectors that can say the same.
I saw that, and what I thought was interesting, there were a couple of stocks outside of it that also had hit records, and they sort of surprised me, talking about Berkshire Hathaway, Visa, McDonald's, and Marriott, so sort of this interesting other cohort. But you're right, this has held up the entire market, which is the reason why when you get $10 trillion of market capitalization reporting earnings in the span of 3 days, people take notice, given all the other catalysts in addition to this. I mean, it's pretty, I mean, holy event risk, Batman.
$10 trillion of market cap across 5 companies.
I know.
Just to be very clear.
I know.
It's kind of crazy.
It's nuts. And you have more than 30% of the S&P reporting earnings this week. Have earnings been good? It's been a mixed bag. And this is something that people also haven't talked about. We're not talking about a screamingly amazing situation for all companies. So, you know, it'll be exciting.
Kicks off with Microsoft and Alphabet tomorrow. Do you actually believe it will be exciting?
I actually, this week it's going to be exciting.
This is not the ECB. This is like,
I mean, come on.
Real
This
deal.
is real deal
Good to know.
stuff. I mean,
Good
come
to
on.
know. Coming up on the program, a massive setback in China's property crisis. Damien Sasser of Bloomberg Intelligence joins us around the table, live from New York City. Equities just about positive on the S&P 500. This is Bloomberg.
This will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
So, Mark.
Are you in?
I'm in.
I'm in.
We're in. Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
You'll hear this a few times this week. Massive week ahead There's a big week ahead. Let's kick it off with equity markets on the S&P 500. Almost going absolutely nowhere, positive by 0.07% on the S&P. The Nasdaq positive by 0.25%. Lisa mentioned the stat, $10 trillion of market cap across 5 names, reporting Tuesday and Thursday. Tomorrow, Microsoft and Alphabet. Thursday, Meta, Amazon, and Apple. That's the equity stage set right now. Let's go into the bond market. 2-year, 10-year, 30-year. Really muted price action last week, Bramo. Yields lower today by something like 3 basis points, 2 to 3 basis points across the curve. 4.1% on a 10-year. On a 2-year, 432.83.
This is a massive week, and it's not just because of the Federal Reserve. It's not because of the jobs report. It's also because we're getting the Treasury refinancing announcement coming out on Wednesday, where they're going to talk about how they're going to borrow money this year. We know that in November, it was actually really market moving. Where do you go ahead of this, right? I mean, if you're going to have such a market-moving week, what do you do other than just sort of like sit on your hands and prepare, get enough sleep over the weekend and get ready for some drama? Because it's hard to know which way this is going to break, given what Yellen did in November, which was basically ease some of the concerns of the market.
I'm looking forward to catching up with Dom Constant of Mizuho,
Agreed.
who thinks that maybe this S&P 500 can break below 4K, which is quite a call from where we are now.
It's a long stretch, given the fact that the economy looks pretty good. A lot of people are saying the economy has to crack for something to get to that place, or else you've got to get some really terrible earnings from some of the Magnificent Seven, which doesn't seem likely given the cloud.
432.83 on a 2-year this morning. Let's turn to crude. Crude, it's what's not happening here that's interesting. We're not getting a big rally, big move higher. WTI 78.22, Brent crude 83.76. Strong rally to end the week last week off the back of the tension in the Middle East. One oil tanker struck by Houthi rebels, Bramo. That got things going. I was expecting another move this morning. Hasn't happened.
It was a Russian tanker. It was Russian oil, not a Russian tanker. It was Transfigura. But to me, that was sort of the indicative moment where even Russian assets aren't necessarily going to be immune to some of the conflict. The fact that people keep brushing this off, does it sort of represent the fact that people are complacent, or does it represent the fact that people are realistic? And ultimately, nobody has an interest in trying to disrupt the oil transport in this section.
Another escalation over the weekend. Under surveillance this morning, a top story, pressure mounting on President Biden to respond after a drone attack in Jordan killed 3 U.S. soldiers and injured at least 34 over the weekend. Iran denying any connection to the attack. U.S. and allied forces saying Iran-backed militants in the area are to blame. President Biden saying in a statement this, Anne-Marie, have no doubt we will hold all those responsible to account at a time and in a manner of our choosing.
It really just depends, Jonathan, what this means. There's obviously going to be a menu. The Defense Department has these strategic attacks already outlined. It depends what the president wants to do. Is it going to be maybe a covert action, maybe a cyber action within Iran, or do they do what the Trump administration did, which is hit a high-level official from Iran, like Qasem Soleimani, and that would send a very clear message to Tehran about what level of engagement the U.S. is willing to go for.
The more people scream and the more people make it sound dramatic, the less the market cares. And to me, I just can't get over that, the fact that the markets keep rushing this off, given the fact that there is real potential disruption. Right now, it feels like things are escalating. To what degree, I guess people are assessing.
Well, there's 2 broad options here. There are many, but let's boil it down to 2. One is you go hard on Iran, or 2, you go hard on Israel and get them to pull back even more. And I'm not sure which choice this administration ultimately goes with.
They already have talked about possibly not shipping as many weapons. The bottom line is, it's an open secret. There is a fissure between Netanyahu and Biden. There is a fissure between Netanyahu and the bulk of the population in Israel. So the question is, how do we really sort of push forward in a conflict where you have a deeply unpopular leader that's pushing ahead with a real hardline kind of policy?
Let's get to the latest with the Israeli Prime Minister saying significant gaps remain in talks to release hostages in Gaza. Negotiators from Qatar, Egypt, Israel and the US all looking to broker a deal. The latest talks reportedly include a 2-month pause in fighting in which women, children and the elderly would be returned first, and later soldiers and those of military age. Anne-Marie, Israel in return would release more Palestinian prisoners and allow additional aid into Gaza.
So the U.S. is pushing for this deal to happen. We saw shuttle diplomacy over the weekend in Paris that likely potentially moved this week to the Middle East. But you have to ask, with this recent attack on U.S. soldiers and potentially waiting for how the Biden administration is going to respond, can this also ruin this potential path, as Jonathan is talking about, of putting that pressure on Israel? Could that potentially be shrugged off now because we might see more escalation within the region?
Elisa mentioned the news from NBC, the reporting that the Biden administration is considering slowing or pausing deliveries of some weapons to Israel. Is that the base case now? That's going to be the next development here.
Well, first we have to remember they need to get an agreement when it comes to sending aid to foreign allies like Israel, like Ukraine, like Taiwan. That is still being dragged on in Congress. And once they get to it, this administration, especially from the base of the Democratic Party, is being pushed to have strings attached when it comes to sending those weapons to Israel.
We'll catch up with Norman Rule, former senior U.S. intelligence officer, a little bit later on this morning. Look out for that conversation. I want to finish on this. China's Evergrande set to liquidate as the country's property crisis deepens. A Hong Kong judge saying the company will be taken over by new management in order to carve up $300 billion in liabilities. As of Friday, Evergrande's dollar notes traded at 1.5 cents on the dollar. Evergrande shares sinking 21% before trading was halted due to the news. We were down about 20.87% on Evergrande. That is not even a penny stock anymore. Elisa, this situation, this was a bear's dream 10 years ago. It's materialized, and yet the whole thing hasn't collapsed.
Well, the whole thing being the housing market, okay, but you have seen a number of sales in China, in mainland China, drop to the lowest level in 2015. You're seeing this sort of slow burn. What I find interesting is that Chinese authorities allowed this to restructure. Is this some sort of controlled unwinding of the housing market, or is this just they don't have control anymore? And things are starting to spiral, and now it's all messaging and trying to figure out where the biggest fire is to put it out.
I'll frame just how bad Chinese markets have been relative to U.S. equity markets. Eric Robertson of Standard Chartered over the weekend with this to say the NASDAQ 100 is up more than 60% since January 23, and more than 150% since March 2020. China's Shanghai Shenzhen Composite Index of A shares is down 15% since January 23, 6% from the March 2020 lows. 6% down versus 150% up. Night and day.
How do you have any confidence to invest in China given policy risk and given the fact that their economy has a lot of major hurdles to overcome and there isn't a cohesive way to do so? And that's why we see that one of the contrarian calls is to go into Chinese equities. It's not getting a lot of traction, I'll just say that, but that seems to be one contrarian view some people have kind of flirted with recently.
Damien Sassow with us around the table, Chief Emerging Markets Credit Strategist for Bloomberg Intelligence. Damien, good morning.
Good morning.
What do you make of the Evergrande news over the weekend?
Oh, it's just more of the same. And look, I mean, this is going to be a real test of Chinese distressed debt sector. I mean, look, this is the first real test of how a liquidation is going to, perform, whether creditors, offshore creditors specifically, are going to be able to come out of this with any money whatsoever, any equity stake whatsoever. I think the verdict still out. But Jonathan, I mean, this is a true test. I mean, this is going to be a real liquidation, and whether or not mainland China actually agrees with the ruling of a Hong Court judge, my goodness. And I mean, all of the operating assets at Evergrande are onshore. So, whether they just keep operating and keep trying to complete some of these unfinished homes remains to be seen. But it's going to be interesting. If you're a creditor, you would say, stop everything. Let's liquidate. Let's get our money back and extract some sort of equity, some sort of return.
Yeah.
But it's just not there.
Ring fence. How ring fenced is this?
I mean, I think it's not ring-fenced at all, but, then again, China has its own ways of changing the rules as we go along, and this is the real fundamental issue that's preventing offshore creditors with getting comfortable investing into China. It's not an issue that's going away anytime soon.
The judge in Hong Kong said enough is enough. Doesn't China need to take that on board if it wants to attract foreign investors?
I mean, you would think so. I mean, it's a very interesting development that's going on between the Hong Kong court system and Beijing, and you would think that the judge has some sort of is communicating, quite frankly, with Beijing and the powers that be. But it just seems like this is really where the rubber meets the road. And again, what comes next? There's really no blueprint for taking a company of this size, this systemic importance to the economy, and pulling them out of distress in China. You're going to need help from the authorities. And remember, the authorities are dealing with $650 million of debt that's got to be repaid this year from the local government finance vehicles, which if they don't get their ship sorted, again, these issues could just get bigger and bigger.
There's no blueprint. There are two ways to take that. One way is we don't know how this is going to pan out, so that's a problem. The other one is this is actually exactly what a lot of creditors have been looking for. Yeah. A blueprint, some sort of model of some sort of unwind, a healthy kind of corporate debt market where there are workouts. Why is it not that? Why is it not the latter?
Well, you said a healthy workout, but again, when it happens for the very first time, when the court system is truly being tested, when the respect and the responsibility and credibility of a judiciary making rules on whether creditors get something or nothing, what those recovery levels are, you're right. it is a test of it, but it's not going to be smooth, and it's certainly not going to be easy. I mean, what we're talking about is a fundamental shift in how decisions are made at the top levels within China and how that relationship between Hong Kong and Beijing is going to be tested.
We've seen a number of measures, just sort of ideas of policy easing in China. How much do you buy into the idea that this is just sort of the predecessor to some sort of big bazooka that they're going to unleash to try to support the economy?
I think the triple R cut was a step in the right direction. I think it's actually something we're seeing, not just let's take it a step back here. It's not just China now. This week, I mean, we're talking about the Fed, we're talking about Riksbank, we're talking about the BOE. What we should be talking about is Brazil, Colombia, Chile, and Hungary, because those central banks are the ones that have been cutting the most. And if anything, come on, I got to talk my ass across. But their expected policy cuts this year are going to accelerate. They're going to go from like 25 bips to 50 bips, or 75 bips to 100 bips. They are picking up, the steam. And if vol does remain suppressed in these levels, dare I say, I mean, GMO's been saying this, a lot of others who are way smarter than I, that this is a very good environment to carry an emerging market local debt. And, I can't disagree.
If we can go back to what China's doing in terms of the short selling, is that going to make a difference? They tried to do this as well in 2015. It seemed to fall flat.
Yeah, blocking short sales is an interesting one. And look, and you're right, in the past it's triggered some really big corrections there, and it's given foreign investors an opportunity to kind of enter at better levels. But I mean, we just have not seen foreign interest in China at all. And it's a sentiment issue now. It's beyond, fundamentals. It's beyond value. It's gotten to be the conditioning of investors to just right now stay away, because it's very difficult to justify to a fiduciary in the US or in Europe or in Japan or otherwise that China's a good actor. End of story.
Should we have a moment of silence for Detroit?
Oh my God, Michael Barr. I don't
That
even
was
know.
it.
Did he make it in? Yeah.
What was that second half?
I was sleeping, but I read about it. Jonathan, I have to say, it's a real shame, because Detroit could have really, done some wonderful things. Apparently, Dan Campbell made some questionable calls there in the second half. He has all year long, some of the work, some don't. When you're talking about the NFC Championship game, you're playing the San Francisco 49ers. It's tough. It's a tough pill to swallow. Yeah.
Super sad. Choke just a little bit. Damien, thank you, sir. Of course. Damien Sassower of Bloomberg Intelligence on the latest in China. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahara Hakez. Hey, Yahara.
Hi, John. U.S. and Chinese officials are set to discuss a fentanyl crackdown. High-ranking members of the DEA, Homeland Security, and more are set to meet with their Chinese counterparts Tuesday. It's the first sit-down meeting following President Biden and President Xi's November pledge to restart counter-narcotics operations. Biden is eager to make progress on the issue, with opioids and border control becoming two hot-button issues in the 2024 election. Nikki Haley has vowed to stay in the GOP primary race through at least Super Tuesday. Haley is expecting a better showing in her home state of South Carolina, saying in an interview with NBC, quote, "I need to do better than I did in New Hampshire." The former UN ambassador stopped short of committing to remain in the race through the Republican nominating convention in July. And Reddit is being advised to seek a valuation of at least $5 billion in its IPO, according to Bloomberg sources. That's despite private trades of the social media company valuing it at less than $5 billion. Reddit is considering going public as soon as March. That's your Bloomberg Brief. John?
Yahara, thank you. Lynn Martin of the New York Stock Exchange in the next hour. Bramo, can that grease the wheels? Encourage some more IPOs down the road?
It depends what the valuation is, of course, but she's going to answer this better than I will. I'm not going to steal her thunder. To me, I just keep thinking about the idea of what people are valuing some of these companies are pre-IPO and how much they're willing to give to some of the valuation in the post-IPO world. I'm just saying, I mean, people have been talking about the reset that hasn't happened.
I know.
And whether people come out to market really depends on whether they get the valuations they like or whether they just want to sit on it until they do.
Lynn with us in about 30 minutes' time. Look out for that. Up next on the program, the race to get into bonds.
I've not had a single conversation over the last couple quarters with the client who said, oh, get me out of bonds. Every single one is saying, how do I get in? When do I get in? Where do I get in?
That conversation coming up next, live from New York City this morning. Good morning. You're watching Bloomberg TV.
I used to have a data point I used to share that 75% of the people had never heard a phone ringing. Just think about it. I didn't say I'd never used a phone. They'd never heard it ringing. Today, 75% of the African people have a mobile phone. They use one, okay? And we will do the same with the internet in the next 5 years. You know, we will do it as an industry, as entrepreneurs. All we need is the space, and we need investment support, because we are the best investment case for this in the world.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Live from New York City this morning. Good morning. Here's the price action on the S&P 500. Equity shaping up as follows. Positive here by 0.1%. Yields are lower by 3 basis points on a 10-year. 410.46. Under surveillance this morning. The race to get into bonds.
I've not had a single conversation over the last couple quarters with the client who said, oh, get me out of bonds. Every single one is saying, how do I get in? When do I get in? Where do I get in? And you see it everywhere. You see it in money market fund assets. They're still at $6 trillion. You talk to corporate treasurers and pension fund CIOs. They're looking to de-risk. Everyone wants higher yields.
Everyone wants higher yields, and they're not getting them now. Dom Constant, head of macro strategy at Mizuho Americas, joins us around a table. Good morning, Dom.
Morning.
Are those higher yields coming back anytime soon?
Not anytime soon, I don't think. I think the issue is basically there's a sort of cyclical story that's evolving, which is definitely going to put downward pressure on yields, is putting downward pressure. But there's still a worry about the structural, which is a lack of fiscal consolidation, the election, the return of a higher term premium, these sorts of things. I think that will come back later. So it's a question of how you weight the cyclical versus the sort of fiscal structural stuff, basically.
So let's find out about the tea leaves to look for that can guide you this week when we hear from the Federal Reserve. A lot of people talking about the balance sheet and how important any kind of guidance on quantitative tightening could be when they stop doing that. The balance sheet has contracted by more than $1 trillion, still $7.7 trillion. How important is that to your view?
The balance sheet is quite important, but it's not, it's not the most important thing. I mean, we've got models that show that if they start tapering QT, you can get some downward pressure on long-term yields. And they definitely kind of want to maybe do that so that they can sort of extend the long-term balance sheet reduction. But the big issue is obviously the front end, and is the Fed going to sort of recognize that it's going to need to start cutting rates at some stage fairly soon this year, and potentially quite aggressively. And that's going to kind of dominate anything really they say on the balance sheet. I would argue definitely.
What's the link between stocks and bonds at this point? Because we've seen stocks kind of move regardless of where the bond market is in the past couple of weeks.
So we do a lot of work looking at, what I call transition cycles when the Fed's done its last hike before it does its first ease. Risk assets generally do pretty well through that transition cycle. You have to kind of wait until earnings really turn down, and that typically can happen actually after they start cutting. So I sort of feel that right now the risk assets are in a sort of relatively safe place. Obviously, when we get the extent to which there's a harder landing and earnings are turning down, that's when you worry about risk assets. And maybe the S&P makes a few more new highs and then sort of takes a bit of a tumble later this year. But we have to wait and see to the extent to which the earnings kind of get hurt.
A number of guests have come on and said that they prefer equities over bonds at this point, that bonds feel riskier because of some of these structural concerns and because the economy is doing well. Do you agree with that?
Well, it's all about timing. So right now, I think your risk assets are okay, and the long end is going to struggle to perform really, really well. My guess is 10 years will go to 3.5%, though. You're probably better off still in the sort of shorter dated stuff like 5 years, and those are things that can rally a lot more. Yeah, but people got to get out of cash. So at some point, you're going to go into some sort of mix of bonds and maybe stay long equities until you know exactly what kind of hard landing you're going to get, because you're going to get a hard landing, and no question. It's a soft landing looks, hard landing looks soft until it's hard. It's going to be hard, I'm sure of that. It's going to happen at the end of the year. So right now, it's a timing thing, is a kind of logic.
What makes you so sure? And just let's start with definitions. Okay. What's a hard landing to you?
Okay, the hard landing will be a sharp increase in unemployment. The reason why it's going to happen with a high degree of confidence, I would argue, is the way this cycle works is it comes through inflation. So a lot of people sort of get it the wrong way around. They look at growth and inflation and the idea that basically inflation might be a lagging indicator. This time, I think it's a leading indicator. So it's going to be the decline in inflation that will hurt profits and earnings, and that will lead to the shedding of labor, because basically there's a lot of labor hoarding going on at the moment, and you're going to see the cracks in the labor market evolving relatively slowly, but they're going to evolve, and then companies will have to respond to that. So really the inflation decline is not a benign indicator of, oh, we've done it, we've got a soft landing. On the contrary, the inflation decline is like, oh my goodness, be careful now what's going to happen to the labor market 6 months down the road. And that's why some people who say the Fed should already be cutting rates, they're not wrong, but you're not really going to, they're not going to have the confidence to do that, basically. So they may miss March. I mean, I think they should cut in March, but that's kind of the issue. Inflation is that indicator.
Unemployment right now, 3.8. Where do you see that in 9 months' time?
The Fed has its own models, which suggests that the combination of this decline in vacancies, and if you see layoff rates going up by, say, they're currently around 1%, slightly less, they don't have to go up very much. You could easily double unemployment. You could easily get unemployment up to the sort of 6, even 7% level. And that's in the Fed's own models. That's Chris Waller's model from 2022 with Andrew Figura. Those guys, we've looked at a lot of that, and that's kind of my concern. That's what you're going to see.
When you see a hoarding of labor and employees, is this across the board, or there's specific sectors, then we have to look at the unwinding?
It's sectors. So what we do is we look at all the sectors. We look at trends, short-term, long-term trends, and you can see where there's excessive employment. Good sector, very much so. Service sector, less so. Within services, there's certain sectors that have really overemployed. Trade, transport, for example, professional business services, dare I say, a little bit. But then against that, you've got leisure, health. They've only just got back to trend. So you kind of know which sectors need to give it up first. And there are clearly signs that they've reduced their employment quite a bit, but they haven't yet started laying off. The unemployment rate only goes up when you get a combination of no hiring and layoffs. If you just stop the hiring, unemployment is not necessarily going to go up, and that's kind of where we are now.
When you say the Fed needs to cut in March and you're looking at the data, the issue I take is that data is not translating to the consumer. You look at polls and people still say they need to be making, say, 5% more in their paychecks to afford everyday prices. Is there a risk that the Fed would cut too soon and it would be a mess in terms of inflation?
So the reason why the Fed is cutting kind of initially is because real rates are very elevated, and they're cutting initially to maintain that elevation in real rates. They don't need to have real rates go even higher. So I think from that perspective, that's the logic of them cutting. When they sort of kick up the rate cuts and they get more aggressive, that's when they really need to bring real rates down, because by then earnings will be slowing a lot, because obviously the elevated inflation is part of an earnings story. It's a profit margin expansion that took place in COVID that gave companies so much profit and allowed them to be a bit lazy on cost. So it's really that kind of unwind, I think.
What kind of downside is there, though, in equities, even with the hard landing that you described, given the fact that it's basically 7 stocks? They're all going to report earnings, or a lot of them, 5 of them, are going to report earnings this week. Probably they'll report really good earnings because they're in a transition spot, and everybody can keep saying kumbaya regardless of what's happening everywhere else.
Yeah, well, I mean, in the end, I mean, again, you know, we run models and we look at the interest rates versus equities and earnings, equity risk premium. You know, you're not going to get more than, say, 20 or 30% downside, I wouldn't have thought, from a sort of, you know, fair value elevated level. So you might go, you know, all the way, you know, back down to, you know, the sort of mid-threes or something like that, but, or four, sorry. I mean, high threes to four. But, you know, you know, it's not, you know, it's yeah, I mean, that's your downside. I think.
You make 20 to 30% downside sound like it's nothing. You won't get more than 20 to 30% downside. When I listen to you, Dom, I don't think many people have heard this that much at all. The idea that we can double unemployment by the end of the year. The Federal Reserve doesn't see it this way at all, does it?
No, not officially. Obviously, they only had like 4.1%, I think. But I mean, you can look at Chris Waller's analysis; it's pretty clear. And you can look at a number of other things that are kind of looking a little bit extreme compared with previous cycles. I mean, the bank lending has slowed down massively. You certainly got elements of the service sector in the ISM as a little surprising. Household employment's a bit disappointing. So I don't think it's a shock to say. You also have to, I think, appreciate how extraordinary COVID was and what it did to the labour market, and therefore you shouldn't sort of rule out anything in a sense. I think it's quite reasonable, actually.
Dom, this was thought-provoking. Let's put it that way. It's good to see you. Dominic Constam there of Mizuho Americas, looking for unemployment to potentially double. We're at 3.8% right now, looking for something that might have a 6 or, dare I say, 7 handle around the turn of the year.
The most compelling part of what he was talking about to me is that inflation is a leading indicator, not a lagging indicator. And the idea that this is what's telling people that maybe the labor market is weaker than people expect. We heard that over the weekend from a couple of Fed officials as well, that they're worried that there is going to be this weakness. We don't know, right? We're not sure. We've gotten it wrong before. We've gotten wrong again. So here's the question. Do you go with this idea of what you believe to be the case, or do you just sort of stay in this purgatory and bet on AI, which seems to be what everybody's doing?
It seems to be what everyone's done over the last 12 months. We'll throw some of those questions at Andrew Balls of PIMCO a little bit later this morning. In the next hour, here's the lineup. Norman Rule, former senior US intelligence official, Lynn Martin, NYSE president, joining us around a table through much of the next hour, and Chris Harvey of Wells Fargo, weighing in on the equity market with a big week ahead for earnings, tech earnings specifically, Tuesday and Thursday. Your equity market right now on the S&P 500 shaping up as follows. On the S&P 500, positive by 0.07%. Just a little lift here. Yields a touch lower, down 3 basis points. Your 10-year 4.1046. In foreign exchange, the euro 108.21, and crude is not running in the way you might expect. $78 on WTI. From New York, this is Bloomberg.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
What do you consider to be the biggest challenge?
Infrastructure that supports trade is the biggest challenge. Our senior brother, President Adesina of the AFDB, estimates the annual deficit, infrastructure deficit in Africa to be over $100 billion. But that over $100 billion is actually also an opportunity for investment. So it is a massive, significant challenge that we are confronting. And my fear is that we may succeed in establishing a very effective legal construct and a very effective legal foundation for trade liberalization and investment liberalization in Africa. But all of that will come to naught if the infrastructure deficit is not addressed, because you will need the goods to move somehow, and you will need to have good trade corridor connectivity, ports, trade corridors that connect countries that are landlocked to the ports.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, Hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything.
DOJ or other authorities
could face bigger challenges next.
It was going to keep bringing World Cup. This is a 3
as the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
What happened was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you know, you got to be smart about this.
I would expect the big tech dollars to start flowing.
The only sectors that have had positive earnings revisions in the last 6 months are tech and comm services. So those are the sectors that, of course, have led the market.
The parts that have gotten ahead of itself are still the parts that you can't ignore, like the tech sector.
AI will definitely be a big issue this earnings season when it comes to Meta, to Alphabet in particular, because it's driving so much growth.
The new tech bull market that started, we think tech stocks are up another 30% this year.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance alongside Lisa Abramowitz together with Anne-Marie Hordern. I'm Jonathan Farrow. Your equity market on the S&P 500 just about positive by 0.1%. A massive week ahead with tech earnings tomorrow and Thursday. The Federal Reserve on Wednesday. Bramo, payrolls on Friday.
So there was this quote from a guy from Nomura. I mean, are you kidding me with this week's event risk? I mean, that sort of seems to be the feel at a time where you get all three cylinders, the economy, Fed policy, and earnings. Earnings front and center for me, because to me, that could really change the whole narrative with tech continuing to be the bright spot and pumping out cash.
I was messaging Stuart Kaiser of Citi yesterday afternoon because the note came late. He was waiting for the Chiefs game to finish, and I said, can you just send it already? I've got to get to bed. So he sent it out.
Did you really?
I did text him. I wanted the note. Come on. He sent it out eventually. And he went through three things. He talked about the earnings, the data, and the Federal Reserve. And he said the most important thing for him was payrolls on Friday. The why is obviously, so we talked about it for a while. For him, good news is good news. And he wants to see if the economic data on Friday is indeed good news.
Especially because we have heard from a couple people raising some concerns about the labor market. We have seen layoffs from a host of different companies, and it's not just big tech anymore. Yet everyone's still getting hired. The quits rate, and we get JOLTS data also this week. And I will say, even though that's not necessarily the most reliable data point, are people feeling confident enough to quit their jobs? Those are the kinds of indicators that could really shape the mood in markets this week.
Things are pretty calm. This market is not moody, so far at least. If you bring up crude, we'll take a look at WTI and Brent. WTI right now is basically unchanged at $78 a barrel. AMH, given the news we all saw yesterday, this is not where I thought crude would be this morning.
And not just yesterday, also what happened on Friday when a Houthis attacked a Trafigura cargo that had naphtha from Russia in it, which Russia was supposed to be off limits, according to these Iranian proxy groups. The issue now becomes the oil market is believing that there will not be a serious confrontation between Iran and the United States, because if they did, you would see oil markets priced much higher.
To me, the issue is there are all of these potential tail risks that are getting louder, and we keep hearing about them. They aren't necessarily materializing yet, but there they are. Are markets truly pricing in that risk, or are they priced to perfection at a time where people are just banking on the soft landing? That's the anxiety that we keep hearing from people, but not necessarily pricing into the market.
We all asked the same question yesterday. Would the events of Friday and Sunday lead to a big reevaluation of risk in the Middle East? And so far, looking at crude, not yet. 83.60 on Brent. Coming up over the next hour, this is what things look like. Norman Rule of CSIS, with the president under mounting pressure to act in the Middle East. Chris Harvey of Wells Fargo, ahead of a big week of tech earnings. And the NYSE president, Lynn Martin, on the ongoing volatility. We'll catch up with Lynn through the hour, starting in about 10 minutes' time. We begin with our top story. Tensions rising in the Middle East. The president under pressure to act. Iran-backed militia killing 3 American troops in a drone strike. Iran distancing itself from the attack. President Biden Biden saying, quote, "We will hold all those responsible to account at a time and in a manner of our choosing." Norman Rule, former U.S. intelligence official, saying, quote, "Absent a change in U.S. policy, the lethal attacks against our personnel and international shipping will continue. These attacks will likely involve different weapons or locations, including the U.S. homeland." Norman Rule joins us now for more. Norman, let's start here. Will we shift from this posture of defense at the White House, in the State Department, for the Defense Department? Will that change in the Middle East anytime soon?
Good morning. It's unlikely that we're going to see a change that takes us closer to confrontation with Iran or any action that the administration would believe would involve the U.S. in a long-term conflict in the region.
Norman, do you think that that's what has to happen to prevent this from happening again?
We don't need to involve ourselves in a conflict in the region, but we're now faced with a scenario where Iran and its proxies believe they've identified a series of actions they can conduct without a risk of serious reprisal. That has lethal consequences for U.S. personnel in the region, and that has significant consequences for the global economy. We need to change that perception in Iran and proxies, and that inherently requires a more significant kinetic response.
So what's a more significant kinetic response that does not necessarily ignite a broader regional conflict?
Well, we could certainly take broader steps against Iranian positions in Syria and in Yemen. We could certainly undertake a more robust attack against all Houthi facilities in Yemen. For example, an international approach that destroyed all of the Houthi missile, mine, drone capacity over time would defang this player and would provide us with greater confidence to move shipping through the area. But this takes allies, partners, cooperation, and coordination, and this is where the White House should be focusing at present, and bipartisan support, by the way.
Norm, do you think we could see the U.S. go after high-level Iranian officials the way the Trump administration did?
No, and indeed, the Trump administration's actions took place only after a considerable period of time where there was evidence and an escalatory approach of warning Iran not to conduct a massive terrorist attack. We haven't seen that at present, but certainly there is reason to believe the United States could go against Iranian facilities in Syria and perhaps Yemen, and Iranians are located there, and bad things happen to bad people doing bad things.
There's been talk of a timeline being set between Iraq and the United States about U.S. troops being withdrawn from Iraq. Where does that leave U.S. troops in Syria, in Iraq, in Jordan at this moment?
Well, we should be careful about confusing a conversation regarding withdrawal with an actual withdrawal. But U.S. forces in the region have a prominent role on not just Daesh, but stopping Iran. A precipitous withdrawal would send a terrifically poor message to a region already shocked by the Afghan withdrawal and concerned over our posture on Ukraine. So I don't think we're going to see any sudden shifts regarding withdrawals in the near term.
Norman, we mentioned this in the last hour. I'd love your insight, perspective on it. How Iran has changed over the last 4 years. The former president, of course, is going to come out and say this would not have happened under my watch. Norman, if the former president becomes the next president, I guess to sit in the White House again, how different is the Iran that he will have to confront today that he confronted yesterday, 4 years ago?
Well, Iran's nuclear program has expanded significantly, and it expanded during a period when Iran had the best chance of a diplomatic solution. Iran's use of proxies has not only expanded, but it's seen that the international community will tolerate this. I think the question is not so much how Iran has changed, but rather how the international community has changed in its tolerance of Iranian activities. And that would be something that I think the Trump administration might seek to address, again, to shock Iran into a position where it would say, we are no longer confident that our actions will produce a predicted response.
Norman, what would that look like? What would they have to do to change that perception?
Consistent attacks against Iranian facilities and those facilities involved in terrorist and operations against the U.S. But we would require partners in the region and partners in Europe to support us. And I think the Trump administration will have difficulty getting bipartisan support given our politics. But the biggest thing we can do to push back on Iran is a bipartisan position on our strategy and partners abroad.
Norman, you said that there would be pretty significant economic consequences if this does escalate in any kind of material way. Can you walk us through what you foresee being the economic disruptions? Right now, markets really aren't responding.
Well, that's true, and I think it's because they've seen that oil flows, natural gas flows have not shaped how the consumer countries are reacting. But imagine a scenario where you see military operations in the Persian Gulf, the Arabian Sea, and the Gulf of Aden with greater frequency. Now there we're talking about a massive disruption of energy as well as container traffic in the world, and that would be difficult for people to get around. For example, the Saudis and others are able to use a pipeline across the center of the country to get oil above the Red Sea choke point. Iran might conduct terrorist operations against that pipeline, so then an expanded regional conflict would have significant consequences.
Well, we haven't seen the markets move significantly. At the same time, though, we do see companies starting to move out of the Red Sea, move out of the Gulf and Aden, and actually take that longer trip around Africa. Even Qatar is doing it with LNG. What can be done to really open up the Red Sea, though, to make sure that there is a flow of energy and good tankers?
A massive disruption of Houthi missile capability and drone capability, followed by consistent pressure against their explosive boat and any naval mine capacity they might have. This is going to be would be a long-term effort and would require a significant decision by the United States and Britain, our primary partner, to do this.
Norman, I'm fortunate that I have to ask this question, but I think we need to. Given some of the errors that have been made on the international stage by this administration over the last number of years, are you surprised by the fact that the president hasn't changed the personnel around him?
I don't comment on personnel decisions, but I did work in a world where consequences came from certain actions and where we were meant to achieve certain product levels. And the bottom line is I'm not sure we're hitting that mark at present, but that's a decision for obviously others to make.
Appreciate your response, sir, and great to get you on the program this morning. Norman Rule there of CSIS. MH, we've asked this a few times. The advice the president is receiving, is it the right advice?
Well, you have to ask also on a weekend where this happened. He had a CIA director, Bill Burns, and he also, I believe, Brett McGurk out of country. These are individuals who are trying to deal with a peace negotiation in Gaza when actually Americans were hit in Jordan. The next question that needs to be asked of the DOD is, and the CIA, was this an intelligence failure? How did we not know about these groups attacking our servicemen and women in Jordan, which is really a training facility, and it's an anti-terrorism facility?
We'll speak to the Pentagon a little bit later on this morning. Crude right now, 78.11 on WTI. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg brief with Yahara Hackers. Hey, Yahara.
Hi, John. Oil's on the move following escalating tensions in the Middle East. A tanker carrying Russian fuel was struck by a missile as it left the Red Sea on Friday in the most significant attack yet by Houthi rebels on an oil-carrying vessel. Meanwhile, the U.S. says 3 service members were killed and 34 wounded in a strike on a U.S. base in Jordan by Iranian-backed militia over the weekend. Tehran has sought to distance itself from the attack. Shares in China's Evergrande plunged 21% before they were suspended from trading, following a liquidation order from a Hong Kong court. The judge saying the property developer will be taken over by new management in order to carve up $300 billion in liabilities. As of Friday, Evergrande's dollar notes traded at just 1.5 cents on the dollar. London homes are the most affordable they've been since 2014. The latest data shows homes cost 13 times the average earnings of a UK worker. That's down from 15 times at their peak in 2016. However, they are still by far the most expensive in Britain. That's your Bloomberg Brief. John?
Yahara, thank you. Let's sit on that for a second. 13 times average earnings. I mean, I get that it's the cheapest, the most affordable since 2014, but 13 times average earnings.
And this basically tells you the story of the housing market globally and the reason why people have been surprised that we haven't seen a bigger correction and the fact that people were hoping for it and it didn't happen. Where does that leave us going forward?
If things aren't getting better, they're getting less worse. You should just sort of frame it slightly differently.
That's well said, and I think that you could say that in a lot of places, which is why people aren't exactly celebrating with disinflation.
Equities on the S&P 500 this morning shaping up as follows. Quick snapshot of the market for you. Equities look like this, just about positive on S&P 500 futures this morning. Lisa mentioned the numbers a little bit earlier. $10 trillion of market cap across 5 names reporting across 2 days. Tuesday, Thursday, Microsoft and Alphabet on Tuesday. Thursday, Meta, Amazon and Apple. Up next on this program, headwinds in the equity market.
We have to balance the fact that the names that have outperformed so much, that are having these earnings revisions, are crowded and expensive. And eventually there will come a point where that becomes a headwind.
That's coming up next on the program, live from New York City this morning. Good morning. You're watching Bloomberg Surveillance.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Live from New York City this morning. Good morning. Stage is set as follows on the S&P 500, slightly positive by 0.07%. Yields are lower by 3 basis points, 410.46. Tension in the Middle East not showing up in the commodity market. Crude just slightly higher, 0.2% higher, 78.20 on WTI. Brent crude 83.70. Under surveillance this morning, headwinds in the equity market.
We have to balance the fact that the names that have outperformed so much, that are having these earnings revisions, are crowded and expensive. And eventually there will come a point where that becomes a headwind. But there's so much momentum right now, you're sort of in the let your winners ride camp. But when something gets crowded and expensive, you're in the area for downside surprise.
Investors watching out for a range of headwinds in 2024. Lynn Martin, the president of the New York Stock Exchange, outlining 3 principal trends that may shape global markets this year. Volatility remaining, a reinvigorated IPO market, and U.S. capital markets continuing to lead the world. Lynn Martin, I'm pleased to say, joins us at the table. Morning, Lynn.
Thanks for having me. It's great to be with you guys.
It's good to see you again. Let's start with the geopolitics. Clearly, the risk in the Middle East is front and center after the events of the weekend. How does that contribute to this theme of high volatility sticking around for longer, in your view?
Yeah, you know, the geopolitical environment's a quite complicated environment. I think we can all agree with that. It clearly impacts the U.S. equity markets and the global equity markets by contributing to volatility. The surprise factor, that's what's going to contribute to volatility. And this weekend's events were, one of those surprises, unfortunately.
We've talked about this before, how capital markets might be increasingly polarized. Regionally, geographically, you might see a situation where it's U.S. capital markets for U.S. companies, Chinese capital markets for Chinese companies. Do you see it quite the same way?
I don't. I mean, the U.S. capital markets are the envy of the world. They have withstood multiple pandemics, multiple wars, and they've really shown to be the best source of liquidity for a founder, for an entrepreneur to raise the capital that they need to change the world. That's true more than ever, in fact. You see the ability to tap the U.S. capital markets as aspirational, but also when you look at the cost of capital, the most efficient way to raise capital to change the world.
Let's put these two ideas together.
Sure.
Do you think that because of the potential volatility, because of the unknowns later this year, are people moving forward their plans for IPOs?
Absolutely. You know, we have a tremendous amount of companies on the road. We're actually about to welcome a large one this week, Immerse, which is the holding company for Wilson, for Louisville Slugger, for a lot of the brands, you know, our children and we use every day. And just later today, we're about to welcome a UK-based company, Flutter, who is transferring their listing out of their regional market over to the New York Stock Exchange a little bit later this morning.
One of the reasons why IPOs haven't been as active as people had expected was because of just a lot of private equity companies not wanting to take the valuation cuts. And we've seen that even with Reddit, right? The $5 billion market capitalization, lower than what some of the previous private market valuations had been. How much are people accepting a haircut, accepting not getting the price that they wanted in order to really cash out of those investments?
You know, I think you had two reasons really impacting the IPO markets over the last 2 years. You had the volatility, the increased volatility, when the VIX is trading at, you know, 30 handle as opposed to, you know, below 20. It's not that founders couldn't get deals done. It was, what is my stock going to do the day after I IPO, the month after I IPO? What macroeconomic factors are going to influence the way my stock is trading? Now you also see that there is a recalibration of valuations in the market. I would make the argument, though, that 2021 had inflated valuations in the market. So, you know, 2021 was one side of tail risk. This is the last 2 years were the other side of tail risks on the bell curve.
There is this structural story as well, and we've talked a lot about it around this table and in Davos as well, at the World Economic Forum, that we're seeing regulations shift that will push more financing activity into private markets. When you start to think about those themes, do you think the lifespan, the arc of a company's lifespan, the timeline of it is going to change, just in terms of how long they stay private for versus how long they stayed private previously?
I think companies are going to be more disciplined about when they tap the public markets. Obviously, they're going to want to be able to articulate a path to profitability or profitability. So I think what you're going to see is when companies come to market, the public markets, they're going to be public market ready. They're going to be able to articulate a very clear message to investors, to their shareholders, that will enable them to thrive. I don't think there's any substitute, though, for the public markets, and that's been proven time and time again.
Have you seen that change already, that change you just described?
Absolutely. With the amount of companies we have on the road. We have a tremendous amount of companies on the road. We have a tremendous amount of companies that we're working with at the moment to tap the public market. So we're really excited about the prospects for 2024.
I want to talk about one threat for 2024 and beyond, AI. I've asked you about this before.
Yeah.
Let's go through it again. Confronting an era of misinformation. For someone in your position, how are we going to go about doing this?
You know, I'm really glad you made the point about misinformation, because AI is just a continuation of data-driven trends that have really existed for more than a decade. If you've got good data, that is going to enable models to add efficiencies to markets. It's something that we've seen in production for more than a decade now with the AI or large language models that we employ to add transparency to the energy markets. And as a result of the large language models that we have had in production for a decade, we've seen the more opaque parts of the energy market have tremendous amount of transparency, tremendous amount of liquidity added to them, particularly over the last couple of years.
Did you guys see what happened with Taylor Swift and X, the AI sort of renditions of her, and that basically it was preventing you from Googling Taylor Swift.
You couldn't search
her on X because they were pornographic, artificially intelligence-generated images. But it sort of shows you some of the challenges in misinformation or just false videos. I am curious how many companies that are planning to IPO are tech companies are billing themselves as such. I mean, is it like 100% they're a tech company even if they sell furniture?
You know, in this digital age, everyone uses technology. Everyone's a technology company. You sort of miss the boat if you're not employing technology in some way, shape, or form to drive your business forward.
Who do you think right now is your biggest competitor, though? I mean, to John's point, the private markets, we've been talking about that for a long time, and there was this discussion about some sort of transfer. Is it just, another stock exchange, or is it another avenue of financing?
I don't really think we have a competitor because the role of the New York Stock Exchange is just very different than a traditional stock exchange or a listings venue. Our job is to be the stewards of the U.S. capital markets, and since the U.S. is such an important part of the global capital markets, we really are the stewards of the global capital markets, allowing entrepreneurs and innovators to tap the markets, to raise the capital they need in a cost-efficient fashion, and to democratize investing.
You expect there to be a much more active year in the IPO world. We have seen this with a lot of banks predicting much more active capital markets activity this year. How much is that predicated on significant rate cuts by the Federal Reserve?
I think the market's already pricing in the rate cuts to a certain extent. The one thing that I'm watching is the discrepancy between the U.S. equity markets and how it's pricing in, call it 2 or 3 rate cuts, and then you look at the Fed fund futures markets. If you go further out in the curve, towards the end of the year, it's pricing in probably 5 or 6 rate cuts. So there's a bit of discrepancy there. The reason why I'm watching that is because that's what's going to impact volatility. Really, volatility is what's going to, I would say, impact the IPO markets. But for the short to medium term, I think we're going to see some good IPOs.
You wrote last year that 70% of IPOs executed actually couldn't meet the provisions on the New York Stock Exchange. What is the biggest provision that's holding some of these companies back from going to the NYSE?
Yeah, so we've got a variety of quantitative standards. A lot of those are focused on the minimum amount of shareholders, the size of a company's float that they actually put into the public markets, as well as the minimum market cap of a company. And you're right, more than 70% didn't qualify for us last year, and that number was even higher in 2022.
Amazing. Lynn, you're going to stick with us, I'm pleased to say. Lynn Martin there, the NYSE president's going to stick with us through the next 30 minutes or so. Let's touch base on the financial markets this morning. Equity futures on the S&P 500, slightly positive by almost 0.1% on the S&P. If you're not familiar with the calendar just yet, it is busy for the week ahead. It starts tomorrow with earnings after the close. You'll get numbers from the likes of Microsoft and Alphabet. Then Thursday, Meta, Amazon, and Apple. The Federal Reserve is the meat of the sandwich on Wednesday. The cherry on top, Bramo, payrolls on Friday.
And in between, you get sprinkles, including JOLTS and Treasury refinancing agreement. So basically, you're talking about a completely packed week on all cylinders of potential volatility nodes.
I say it all the time. It's my favorite week of the quarter. This is it.
And it's earnest, and I actually agree with you.
It's genuine. It's not like your description of being excited for the ECB.
Okay, you're going to keep harping on that.
Last
I was
week.
not wrong.
I mean, I shared that view too. Coming up next, Chris Harvey of Wells Fargo, with stocks looking to extend 3 weeks of gains. From New York City, you're watching Bloomberg Surveillance.
regional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it, Peacock?
Yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was and when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
3 weeks of gains on the S&P 500. Equity futures this Monday morning, just slightly firmer, positive by almost 0.1%, 0.11% higher on the S&P 500. On the Nasdaq, positive by 0.25%. The Russell of small caps, totally unchanged. We've gone through the calendar for earnings. Let's talk about the calendar for bond issuance. The bond market looks like this: 2-year, 10-year, 30-year. Your 10-year yield is lower by 3 basis points, 4.1046. The 2-year down a single basis point. Lisa, 4.3324. The refunding announcement was a big deal last time around, and I guess we're not talking about it anymore because that 10-year has a 4 handle and not a 5.
The reason why it was a big deal is because everyone was saying, oh my goodness, the Treasury Department is going to have to increase their issuance to these record auction sizes. It's going to torpedo market valuations. Yields are going to surge. And then Janet Yellen came out and said, I'm just going to all do it in the T-bill market, and everything was good. This time around, she's not expected to really surprise, but I want to put this into perspective. The expectation is for the U.S. to announce $4.1 trillion of Treasury sales for 2024. $4.1 trillion. Evidently, there are not enough bonds, according to some people, but I will just point out there are others who are watching this very closely to understand exactly how they're going to be sold.
When you say some people, you mean Bob Michael's clients over at JP Morgan. Yeah. Just clearing that up. Let's turn to crude. WTI and Brent crude both look like this morning. WTI is basically unchanged. Brent crude as well, 83.60 on Brent. WTI at $78 and about 10 cents, which is unbelievable considering this top story. Under surveillance this morning, President Biden under mounting pressure to confront Iran directly after 3 U.S. troops were killed in a drone strike by the country's proxies. Iran has denied any involvement in the attack, but a person familiar with the U.S. position said the strike would warrant a stronger response than anything they've done since Hamas militants attacked Israel in early October. AMH, the what if happened over the weekend. What next?
Well, this is the problem the Biden administration is in. You have GOP lawmakers coming out, some even saying, like Lindsey Graham, hit Iran hard now. It's a level of escalation potentially that this administration has really been trying to avoid. And you have to just ask yourself, though, is this going to be a red line where they go even more aggressive on Iran? Or is it going to be the continuation of deterrence?
We spoke to Norman Rule about 20 minutes ago. He didn't use the word deterrence. He used defense. We've been on the defense. It's not worked. It's not stopped them.
And then basically the message, if they don't take some sort of harder action, is that they can keep kind of having these levels of lower grade altercation, and it's not going to warrant some sort of significant response. To me, I just want to understand, what are the red lines? Because right now, I don't have a good understanding of what Iran's red lines are, and I don't have a good understanding of what the U.S.'s red lines are.
I think we can expect this to spill over into the campaign trail, that's for sure, this year. Nikki Haley refusing to quit the GOP race, vowing to continue until at least Super Tuesday, despite back-to-back losses to Donald Trump in Iowa and New Hampshire.
As long as I keep growing per state, I am in this race. I have every intention of going to Super Tuesday. Through Super Tuesday, we're going to keep on going and see where this gets us. That's what we know we're going to do right now. I take it one state at a time. I don't think too far ahead.
Haley and Trump going head-to-head in South Carolina next before Super Tuesday in early March. We were talking about whether she makes it to Carolina, South Carolina, never mind early March.
She's calling this a, quote, building situation. She says that she wants to keep gaining momentum, and her baseline at this point is not beating Donald Trump in a caucus or primary. It's making sure she does better than the prior date. But it's going to be very embarrassing for her if the polls continue to show what potentially may happen to her in South Carolina, in her home state, but she's lagging the former president 20, 30 points.
New York Stock Exchange President Lynn Martin alongside me. We talked about politics, remember, in Davos, and the whole room just went quiet. No one wanted to discuss. Does this change your world, this race this year?
You know, the only way it changes our world is it's impacting volatility and the IPO window. And our job is to make sure that, particularly in years like 2024, our systems are reliable, resilient, and open so that people can efficiently manage risk.
That's how you diplomatically sort of dodge that question, without addressing it.
Basically, they're going to look at the markets and not address the politics of it. I will just say Saturday Night Live will get funnier because they seem to really enjoy this. There was a great week in review. Basically, they had a picture. They had a picture of Trump and Biden, and Colin Joe said, "Well, guys, it's 2024." But is it? And that's sort of where we all feel. It's like 2020 was so great, we want to do it again. And that seems to be where everyone is.
It's kind of sad, isn't it? The week ahead, though, is interesting. Big week ahead for tech earnings. Microsoft and Google set to report after the bell tomorrow. Amazon, Apple, and Meta following on Thursday. The 5 companies have a combined market value of more than $10 trillion. With the tech giants again at the forefront of a rally in stocks, which has the S&P on track for its 3rd straight month of gains. It's been quite a run, Lisa, over the last year.
I mean, it's just been NVIDIA. I'm sorry, I was looking at the gains. I mean, we're talking about big tech, yes, but there's sort of a hierarchy of big tech. NVIDIA's at the top, Microsoft and Google to some degree. At the very bottom, I mean, you have, Tesla, if they consider it, but you have some of them that are really at the bottom. So the question is, how vulnerable is this market to disruption, given that so much of the rally has hinged entirely on 7 stocks?
Chris Harvey of Wells Fargo is going to make it interesting for us, maintaining his year-end S&P 500 price target of 46.25. Chris is with us around a table. Morning, Chris.
Good morning.
The path to 46.25, how difficult is this year going to be?
That's going to be not so easy. But we do expect a lot of volatility. We haven't seen the volatility yet. And the one thing that surprises us is credit spreads at IG credit spreads at 92 basis points over. That's dampening a lot of the volatility. The other thing is during earnings season, you have a lot of idiosyncratic information, hard for volatility to spike up despite some of the geopolitical, but on the geopolitical side, it is starting to get to be a bit of a worry.
Lynn was talking about that high volatility as well. You went straight to credit and talked about how tight spreads were. Do you have to assume for your world to play out, for things to get harder, we're going to see some credit issues sometime soon? And where do they come from?
Yeah, you have to see some credit issues because credit and volatility go hand in hand. And I think that's one of the reasons why volatility is so low. And the bid for, I think you were talking about Bob Michael before, the bid for rates, for duration, now all of a sudden, at 5%, nobody wanted to buy duration. At 4%, everybody wants to buy duration. And in addition to that, what you're seeing is you're seeing the all-in buyers. It's less attractive now, but at the end of the year, you saw shorter duration paper really, really attractive. It was hard to lose money on that kind of paper. So you have people not buying because of credit, but because of the fatter yields and because they can make a lot of money on that. The break-evens are attractive.
When you zoom out, the balance of risk seems to have shifted. At the end of last year, people were talking about maybe there was risk that things would just be so much better than expected and you'd miss out on the rally. Now it seems like it's on the other side, that if unemployment starts to pick up, if that weakness starts to pick up, that's what's going to really draw into question some of these tight credit spreads and some of these perfect valuations. Am I right?
So Lisa, a couple of things there. One is we've seen a different mentality. It used to be that you wanted to buy low and sell high. Now what you do is you buy strength and you continue to buy strength. And when you see weakness, then you start pushing things down, but not until you see weakness. And then the other thing is, with credit spreads this low, we don't see weakness with credit spreads this low. You don't see a recession with credit spreads below 100 basis points. So a lot of our assumptions, 1.5% GDP, not inflation, but unemployment going a lot higher, that's not associated with these kind of credit spreads. Those credit spreads are telling you that the economy is strong and the corporate market's even stronger.
So does that mean that you are bullish? Then how do you sort of wrap yourself into a negative frame of mind if you're basically painting a Goldilocks scenario?
No, we're not bullish. What we're doing is we're putting a lot of our focus on positioning, right? What we think is we want you to be growthy, right? So we're looking for communication stocks, which have done pretty well. But we're also trying to be a little bit more conservative and saying, okay, you have some oversold situation in the market, healthcare and utilities. So you want to use that and balance in the portfolio. You want a barbell communication with something more defensive, something oversold, and that's healthcare and utilities to a certain degree.
Lynn, when you talk about volatility, how much is really driven by an unexpected weakening in the economy? Is that what you're really referring to that is potentially the greatest supplier of volatility, or is it a lot of different things?
You know, it's a lot of different things. And the important thing to look at when you think about volatility, so there's the VIX, which is clearly the measure of equity vol, but then there's also the MOVE, which is our index, which is the treasury market vol. And those levels are still elevated. It's still above 100 if I look at the MOVE index, which I do every day.
One of the things that surprises me, just the move at the front end, the 2-year, the bouncing around of the 2-year is incredible. So if we don't really know what the cost of capital is that volatile, why are equities so placid? And that's surprising. At some point, you should see that spill over into the equity markets, and maybe after earnings season.
Do you think that's settled down, though, just a little bit more recently as the Fed starts to engage a conversation about cutting interest rates?
Did you see what happened after CPI and PPI? The 2-year just dropped 10, 11 basis points, and then another 10, 11 basis points. And then a couple days later, we're back up. So will it change once the Fed starts talking? Maybe, but that's a lot of volatility.
Lisa's like, what's 10 basis points between friends after the year we've just seen?
I'm old enough to remember when it was 25 basis points a day. I mean, I'm just saying, theoretically.
There were massive moves in October.
Exactly.
I would say relative to then, things are calmer.
All I can say is somebody wrote in, a friend of yours, Chris, who said, equity guys talking credit, you know spreads are too tight if that's the case. Just want to point that out. So someone who is bringing that up.
How many times have we seen that, though? Equity strategists focused on the bond market.
Right now, what is the message, though, from the bond market? And this, to me, is the lack of clarity. Both Lynn and Chris talking about volatility in the 2-year, and yet, if you look at credit, it's saying the all clear.
Yeah.
So how do you know which it is?
So you don't know which it is. It's really, it goes back to this, some of the kids' shows you used to see. Which one of these things does not belong with the others, right? 92 basis points over doesn't belong with a lot of the other things, with Fed cutting, right? It doesn't belong with a GDP of 1.5%. And so there, you're right, there are a lot of confusing situations in the market, which is why we're focused more on positioning, because the macro is really, at this point, really hard to get a handle on. And eventually, we're going to see perception change. We're going to see some volatility come back in the market. That's traditionally what you've seen with volatility this low.
This is John's favorite week. I don't blame him. It's actually a really exciting week. What's the most important thing of all of the different events on the 3 cylinders that markets really pay attention to?
We're focused on what Janet Yellen has to say about issuance, and we're focused.
Thank you.
And obviously, we're focused on what Powell has to say in the press release. The presser's always dynamic. It's always interesting, and you can have some new information come in the presser.
Did you say Yellen just to please Bramo?
No, I did not.
That was?
Come on, you don't think that that's actually interesting? It's incredibly interesting.
It wasn't in my top 3, but I agree with you, it's interesting.
Thank you.
It's what started the rally. When she brought expectations, or she came in below expectations on November 1st, the market was already beginning the rally, but it was that really helped settle down the bond market, which helped rally the equity.
Certainly one of the catalysts. Chris, it's good to see you.
Good to see you.
Chris Harvey of Wells Fargo. Equities right now on the S&P 500 positive by not even 0.1%. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahara Hakez. Hey, Yahara.
Hi, John. It's a key week ahead for the U.S. economy. The Fed is expected to keep rates on hold on Wednesday, but Jay Powell's press conference could offer clues as to when they'll begin cutting rates later this year. That comes ahead of the January jobs report due out on Friday. Low-cost carrier Ryanair lowering its profit guidance for the fiscal year, citing higher fuel prices and issues with third-party booking websites. The airline, a major customer of Boeing planes, also claiming they don't foresee any disruption to their aircraft delivery schedule and are seeing improved quality out of Boeing's Seattle factory over the last few weeks since the Alaska Airlines incident. The Chiefs and 49ers are headed to Las Vegas for the Super Bowl. Kansas City aims to be the first back-to-back champions in almost 2 decades. It's not clear whether Taylor Swift will be there to support boyfriend and Chiefs tight end Travis Kelce, as her tour schedule has her in Tokyo through February 10th. the day before the Super Bowl. That's your Bloomberg Brief. John?
Yahara, thank you. I love that for so many people, that's the only part of this story that matters. Can she make it there?
Yeah, I got some hate for calling the Super Bowl the show, but I mean, at a certain point, that's what it is. I mean, that's
Isn't it a show? I've got some stats.
I only tune in for the halftime part. Really? Yeah. The whole thing is kind of a show.
The average NFL game.
And the commercials. And
the commercials too.
If Taylor Swift's going to be there, what if the commercials going to be geared towards people like me?
The average NFL game, I think, is about 3 hours long. The action's about 15 minutes on average.
Exactly.
The whole thing is a marketing ploy.
Okay.
It's 15 minutes of continuous play.
What do you think? What do you think is better, American football or British football?
What do you think?
European football. I know you're.
Next on the program, what is better? Up next, the outlook for inflation.
We are in the sweetest spot of the inflation reduction right now. It's going to get tougher going forward.
That's coming up next on the program. You're watching Bloomberg Surveillance.
Maybe I should go do something else. I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
DOJ or other authorities
could face bigger challenges next.
Was going to keep reading World Cup. This is a 3
as the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Stocks on the S&P 500 just a touch positive to kick off Monday morning. Good morning to you all. We're up here by 0.07%. Yields are lower by 3 basis points. 410 at 65. One eye on crude all morning. $78 on WTI. We're basically unchanged here, Bramo, even with that tension in the Middle East.
People are learning just to shrug it off until they can't anymore. Unclear what's going to necessarily trigger that. But right now, there's no sort of signal that the U.S. is going to materially change its defensive stature.
Unchanged on WTI and on Brent as well. Under surveillance this morning, the outlook for inflation.
We are in the sweetest spot of the inflation reduction right now. It's going to get tougher going forward. It's not out of the question that not only does inflation stabilize, but once in a while you get the rate going up. And that would really impact perceptions. It is getting harder to grow in this global environment.
U.S. core PCE showing inflation cooling as 2023 came to a close. Andrew Balls, the global head of fixed income at PIMCO, writing the following. After major economies showed surprising resilience in 2023, we anticipate a downshift towards stagnation or mild contraction in 2024. The standout strength of the U.S. is likely to fade. I'm pleased to say that Andrew joins us now. Andrew, new cyclical outlook. Great to catch up, sir, as always. How to navigate the descent. Can you just put a little bit more meat on those bones? Just how much of a descent are we about to confront over the next year?
Yeah, so globally in the US, but in Europe, across most markets, we're expecting interest rate cuts this year. this comes after the very big hiking cycles that we saw, and we see inflation peaking and growth peaking, and then there's a lot of uncertainty as you go into this year. The US has been a standout in 2023, stronger than the consensus expected. A lot of people thought there would be a recession last year. We think that probably the US is going to slow down this year, kind of catching down with what we are seeing in Europe. And then the baseline is pretty benign, I would say. A slowdown, but not a deep slowdown, a rise in unemployment, but not a really big rise in unemployment. And that should be enough for inflation to come down towards central bank targets. We've had a lot of good news already on inflation, but then just very big uncertainty about all the different parts of the puzzle and how it comes together. So it's going to be a really kind of interesting year for active managers, and a lot of risks to guard against.
Andrew, you talk about a slowdown and underperforming, or at least a right-sizing of the U.S. economic outlook this year. You talk about things slowing. Do you think right now investment-grade corporate credit in the United States, with a spread of 92 basis points, 12 basis points away from the cycle lows that we saw just 3 years ago, do you think that that's overpriced, priced to perfection, not something you'd want to buy?
So I think in the baseline, investment-grade credit looks okay, and I agree you're not going to see an awful lot of tightening from here, but you earn the income and very high-quality issuers, very default remote. But then you have the risks around the outlook, and when economies are slowing down, you can certainly get a lot more than anticipated. Judging the impact of the tightening cycle that we had before is something which is very difficult. So I think investment-grade credit looks fine, but it makes sense to guard against lower rated credit, more economically sensitive, more leveraged parts of the market. And when you have really good prospective returns from high-quality fixed income, the returns on sovereigns look pretty good here. The return on investment-grade credit, U.S. agency mortgages. When you can do well up in quality with these high-quality fixed income instruments, then you don't need to go down in quality. You don't need to go to the more leveraged, more economically sensitive parts of the market. So good returns are possible, and keep your options open as we navigate this year as we go through to see the balance in terms of growth and inflation risks.
So before we get into outside of the U.S. and where you're sort of shifting instead of the U.S., I am just curious. I want to sit on the sovereign debt point for a second. You think that that's a steady place to go at a time where we're about to get a refunding announcement from the Treasury Department with potentially $4.1 trillion of Treasury sales. We have a Fed that is unclear in terms of their trajectory. What's the risk there? I mean, do you agree with Bob Michael that there's just a shortage of bonds and that's really the main issue in the U.S.? Or do you think that there is some sort of deficit and structural risk with yields potentially going higher in the U.S.?
So I think there's a lot going on. So I think in terms of high quality fixed income, the yields, US 10-year Treasury is close to 4%. The yields look attractive, and you look at aggregate type bond indices, 6%, 5, 6, 7, 8% with more credit type of yields for high quality bond funds look very attractive. You have supply. To a reasonable extent, the supply information should be known. And it should be priced in, but supply is something which is certainly something to keep an eye on. And you have at the front end of the curve the big uncertainty over the path for the Fed. So a lot going on overall. I think there are medium-term concerns on the U.S. fiscal policy. We have a U.S. election coming up this year, obviously, with implications over time for fiscal policy. But when you're getting kind of 5, 6, 7% nominal yields, this is an indicator of future returns. Is one of the best indicators there is, and in that context, high quality fixed income looks very attractive.
Andrew, high quality. Let's talk about the rest of credit. We caught up with JP Morgan Asset Management just last week. Constructive. on credit, taking credit risks. We heard the same thing from Amanda Lynham at BlackRock. Interested in high yield, not all the way down to triple Cs, but interested in the rest of it. Andrew, where are you and the team? Where in high yield credit do you want to be? Where do you want to avoid?
So I think in high yield, it's always a case of picking the names, rising stars, the issuers which you see on a path to investment grade over time are always one of the key things that our analysts are looking for. But I would just take a step back and say that you can get, with the high quality instruments, if you use government debt, investment grade credit, US agency mortgages, private label mortgages, you can get high quality portfolios which give you attractive yields, 5, 6, 7% type yields without needing to go down in quality. So yes, there's going to be lots of opportunities in high yield, but in terms of asset allocation, that up in quality bias, I think, makes a lot of sense in this economic environment. And if you do get, say that we get worse than expected macro outcomes, equity market outcomes, more being priced in for the Federal Reserve, in that negative tail, which is something you should pay a lot of attention to, there may be really good opportunities later to add to lower quality credit in a market where you see repricing. But for now, I think you can achieve a lot of what you want to achieve up in quality.
Andrew, let's just finish on the Fed just briefly. I want to go back to the secular outlook that you and the team put out in the middle of last year. When you said Chairman Powell would accept 2 point something on inflation, that was slightly controversial at the time. Less so now, because a lot of people have moved in that direction. We're at the 2 point something after the read of last week. Is that sufficient to say let's go in March?
Well, I think they have optionality, and I know you've talked about this on your show, but the gap between CPI and PCE is something which is important, and it gives them optionality. So I think overall, I don't see why they would be in too much of a rush. The inflation data is improving, but the GDP data still remains quite strong. The labour market data remains strong. So our best guess is that they'll certainly keep their options open for March, but it's more likely that they go later in the year. But if the PCE does clearly give cover, given the wedge, given the medical related costs there, if they wanted to ease earlier, that certainly gives them cover. And inflation coming down below 3%, it gives you the wherewithal to start easing monetary policy over the year. You don't need to come all the way down to 2.0, but I think that clearly there's enough in the inflation data now that this is a matter of timing. For our taste, there's quite a lot priced in for this year, given the ongoing strength of the labour market data, the broader data, but this could change, obviously, through the course of the year.
Andrew, thank you. Andrew Balls there of PIMCO, and thank you to the brilliant Lynn Martin, the NYSE president, joining us around the table for the last 40 minutes or so. From New York City in the next hour, Major General Patrick Ryder of the U.S. Department of Defense, David Leibovitz of JP Morgan Asset Management, Robert Sokin of Citi, and Mandeep Singh of Bloomberg Intelligence. A massive week ahead, a preview next hour.
Look at the number of women that want to learn the game, young girls that are joining on the tee. Really an exciting time for all of us to really capitalize on this moment. When you look at women who are making most of the purchasing decisions in households, whether that's cars or that is home or financial services, and who are going to drive the wealth of the future, it's women.
Obviously, we have our car business and we need to have games here and all that sort of thing. But what else can we do? How do we grow the platform? The whole ticket pricing process. It used to be very yellow sheet of paper, maybe some numbers around it. There was not a lot of science behind it. We're now in the world and have been for many years, as most other similar businesses are, into dynamic pricing. So our pricing for a seat may change hourly if we see demand for that, all driven to maximize revenues.
The balance sheet is so important to the success of the team. And a big part of my role is to make sure that the balance sheet stays strong and that we are prudent stewards of capital. There are things that we can do that are irrespective of winning or losing. Take a look at the first budget that comes from one of the teams and ask questions about Do you really need to spend that much? Are you really shooting high enough when it comes to partnership revenue?
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything.
This is Bloomberg.
Our base case in the U.S. is for a rate cut in the second half of 2024.
I think the next leg in the recovery is when you actually start to see cuts.
June is where the market has gravitated to.
There definitely is cover for them to start to cut.
It will come in the beginning of the summer, call it June, maybe July. Not only do I think that that's what's going to happen, I think that that's what should happen.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
People are excited about the Federal Reserve. Payrolls on Friday, the Fed on Wednesday, lots of earnings Tuesday, Thursday. Bramo. Treasury refunding. A little bit later this week. Top story. A little bit later on the program.
Okay, look, it might not be the top story, but this, did you hear? We heard that from Chris Harvey. This is what ignited the rally in November 1st when Treasury Secretary Janet Yellen decided not to issue long-term bonds. Just say.
It contributed to the move, we should say.
I think
we say that the catalyst for the move, ultimately. Chris Harvey of Wells Fargo on with us a little bit earlier, looking for 4,600 there and thereabouts on the S&P. Dominic Constam earlier on this morning from Mizuho, suggesting that unemployment can climb to 6 or 7% by year end. That is a very, very different call than what we've heard so far this year.
And it was predicated on this idea that inflation is actually a leading indicator, and the disinflation that we've seen is a leading indicator of some of the weakness that we will see in some of the economic figures. I'm also watching JOLTS. Again, some of these sleeper kinds of indicators, the idea that the quits rate has been climbing. People feel confident enough to quit their jobs. Oh, no, they don't. And I think that's a problem.
Tons of economic data through the week. I think this morning you start with the commodity market. You take a look at WTI, you look at Brent. After the events of yesterday, you're expecting a big move higher. You don't get one. We're unchanged on WTI. Brent crude right now. AMH 83.30 on Brent. We're negative on the session.
It's pretty remarkable given this was the moment that everyone was so worried would happen, an escalation that potentially would bring the U.S. and Iran face to face. But everyone's starting to look at that and say, we'll probably see more defensive structure from the United States, but they're not going to do what Lindsey Graham, the senator from South Carolina, is saying, which is go into Iran and hit them hard. But Biden said over the weekend in a statement, and also when he was campaigning in South Carolina, he said, we shall respond.
What I'm curious about is how do you price out the risk premium of all of these potential tail risks that seem to be percolating out there? Because right now, a lot of people are saying price to perfection, including Greg Jensen of Bridgewater when we were in Davos, spoke to you, John. But to me, What is the premium, and why are we not seeing it baked into things that are hitting record highs?
Well, we are seeing a bit of a premium when you want to ship through the Gulf of Aden and through the Red Sea, which is why you're seeing so many now, not just consumer good vessels, but Qatar sending LNG to Europe. This is Europe's lifeline, given the fact that they ditched Russian natural gas. They're now going around Africa, so this can start to become a bigger problem.
Prices are basically back to where they were in November, and the triple-digit calls for crude were in September. Remember those? Amrita Sen, Energy Aspects, triple-digit crude by Halloween. We then got an additional dose of risk in the Middle East after the terrorist attacks in early October, and yet here we are. We just didn't rally in the way people thought we would in crude.
It's been a widowmaker. I mean, that's one of the contrarian trades right now, is to lean into oil. Well, it hasn't worked. And why? Well, some people say it's because of the U.S. oil production. Other people say because right now there isn't anything that would truly disrupt oil shipments. That's the reason why Friday's move was probably more notable than today's in response to an attack on a Transfigura oil tanker that was carrying some Russian oil.
And last week, crude, of course, rallying by more than 6% on the week. I think the biggest weekly gain going back to September. The broader price action right now on the S&P 500, we're totally unchanged, not just on crude, but on S&P 500 futures as well. In the bond market, yields are lower by 3 basis points. The 10-year 410.46. And in foreign exchange, the euro slightly weaker, dollar stronger here, 108.19. Coming up this hour, in the third hour of Bloomberg Surveillance, David Leibovitz of JP Morgan on a big week for equities as tech earnings begin. Citi's Robert Sokin on his rate cut call ahead of the Fed's decision later this week. And Major General Patrick Ryder on increasing pressure on President Biden to act in the Middle East. We begin with our top story, markets showing caution ahead of a Fed decision and big tech earnings. David Leibovitz, global strategist for multi-asset solutions at JP Morgan, saying this: the combination of more moderate growth, softer inflation, lower rates leaves us constructive on the outlook for U.S. equities. At the same time, however, we recognize how aggressively markets have moved since the Fed's December pivot. David, I'm pleased to say, joins us around the table. Morning, David.
Morning.
Bramo's done this already. Let's go through the top stories this week. So we've got the Fed, earnings, payrolls, Treasury refunding, ISM jolts, all of that stuff.
Job.
Thank you. What are you focused on?
So I think that we need to separate the data into two pieces. One is going to be the earnings, and the other is going to be more of the macro, the payrolls, the Fed data, so on and so forth. On payrolls and the Fed, I don't think the Fed's going to move this month. I think that they may send a signal to help people begin to ground their expectations and build a base case for what easing looks like this year. And we do think that the Fed will ease policy. Then we're going to have the jobs report on Friday, right? I think that the reason the Fed is going to be a little bit cautious here is because the economy's running hot. The jobs numbers have been good, and they don't necessarily want to paint themselves into a corner saying they expect to do something and then end up with a print that could go one way or the other. And then underlying all of this, you have earnings. And markets have moved aggressively, like you pointed out in that note that I wrote. The earnings need to come through. And I think that that's where we're spending a lot of time thinking. You look at expectations, particularly for the big growers, the tech companies, they're pretty solid. And so those earnings need to be delivered. And obviously, this is our first glimpse at what that looks like going into the end of last year.
So far, we've gotten a slew of earnings. They've been mixed. They really haven't been consistent across the board. And it seems like with each earnings report, it really is viewed as a company-specific story, not necessarily a broader market trend. Do you expect that to continue, or do you think that these big tech names have a different kind of patina around them?
So you make a very good point, because if you look at the reaction to big beats or big misses, companies are being punished for missing, but they're not necessarily being rewarded to the same extent for delivering those earnings. Big tech is a little bit different because given the sheer weight in the benchmark, right, it's going to dictate what the market does in the fourth quarter earnings season. And so to me, it's still a very micro story, but we need to be cognizant that there's almost a sentiment overlay here where if they miss, even if they're not missing significantly, that could very well change the tone that has been pretty positive here over the past couple of weeks.
There's so many risks. This is an incredible event-driven type of week, and I just wonder if you think that there is enough of a risk premium baked into certain equity valuations that some people are saying are priced to perfection. I take issue with that. It might just be a couple of the names, but in a broad sense have rallied in the face of a lot of uncertainty.
I think the bigger problem here is that the market broadly is kind of doing a victory lap on inflation, right? Everybody's like, look, it really was transitory. It's coming back down. It's where we want it to be. What they're not recognizing two things. One, on the other hand, economic growth is still very solid. yeah, it's going to downshift over the course of this year, but given the numbers we saw last week, things are clearly not falling out of bed. The other thing that people need to weigh is that the balance of risks is now becoming more balanced. It's not just about inflation, it's about the top side and the downside risk to economic growth going forward, and I'm not really sure that that's being accurately priced in the current environment.
Dominic Constant of Mizuho was on the program in the last hour or so. He was pretty emphatic about what he thinks about inflation. He said it's a leading indicator. Earnings go next, unemployment follows. His call on unemployment from south of 4 now to maybe north of 6, approaching 7%, potentially by year end. I have to say, we've barely heard any of that around this table on this program over the last 12 months. Your thoughts on that?
So I would push back a little bit on the idea that inflation is a leading indicator. If you actually listen to what corporations say, and I think tying it to earnings is particularly interesting, but you look at what corporations say, they say, look, we only raise prices if we think the demand is there. So the leading indicator is what pricing power is doing, but what shows up in the BLS numbers is going to be a lagging indicator at the end of the day. The comment about unemployment is interesting because there are more people that are pounding the table saying we think that growth is going to slow materially. Some people saying that growth may even have slowed materially into the end of last year, although the numbers don't necessarily confirm that. I think that the question here going forward is how much cooling do we need to see in the labor market, and can we continue to destroy job openings without destroying jobs? If we can do that, then the path to 2% without a recession should be relatively smooth. If we boil the toad and we do get that back up in unemployment, I'm not sure we go to 5-6%, but I do think that we move materially higher from here.
I love the expression boil the toad. It feels like we're in kind of this moment of boiling things. But I'm curious, his point, just to sort of stick on what he was saying that disinflation actually creates smaller profit margins for some of these companies and will actually lead to layoffs. It's not that it's necessarily a leading indicator, but that itself could cause a greater degree of unemployment. How much are you seeing the disinflation that's coming through in the numbers being a real negative for the bottom line for a lot of these companies that are reporting?
Well, so I think that I would make 2 comments there. One, yes, I mean, logically that very much makes sense. Your margins get squeezed, your earnings come down, you need to either cut back on your CapEx, and there's not a lot of CapEx today, or you reduce your labor bill, and so you let people go. What we've seen over the past couple of years, though, is a real hesitancy to part ways with labor. I still think we're in an environment of labor hoarding to an extent, and when you look at some of those kind of headline job cuts that we've seen, they've been made more in a preemptive way rather than a reactive way. And so I'm not so sure that people are willing to kind of cut the cord and let people go the way that they have been in the past. That said, when it comes to the economy, it's important to remember that the S&P 500 companies aren't going to dictate what happens with the unemployment rate and payroll job growth, right? That's about small and medium-sized business. And so one of the things that we're particularly focused on going forward is, are we seeing a growing divergence between what the Fortune 500, the S&P 500 names are doing, and what's happening on Main Street across the United States?
What about consumer sentiment? You talk about Main Street. We had all of this household income, the COVID money really was piling up, and now people are actually going back to credit card debt. At some point, when is that going to be really impacting the data?
So we've seen the rise in credit card debt. You can see it in the national statistics, the Chase data, the Bank of America data, so on and so forth. Importantly, if you normalize that based on cash flow, the overall kind of income ratio doesn't necessarily look all that nefarious. But, I mean, we are seeing late cycle signals. I don't want to be sitting here suggesting that we're at the beginning of some new economic expansion. We are seeing things begin to move towards that late cycle environment. I think that the deterioration we've seen in sentiment, the increase in credit card debt, the lower savings rate, I mean, the list is becoming longer and longer and more distinguished. And that's why I think bringing it back to the Fed, do they go in March? Probably not, but they likely ease at some point in the second quarter to try to get ahead of any weakness. And we all need to remember, if the Fed keeps the policy rate where it is and inflation's coming down, things are getting inherently tighter.
That's the passive timing that the likes of Deutsche Bank and Marzelli have been talking about. Just before you go, favorite idea right now, what is it?
So we like high-quality U.S. equities. We like large cap in the United States. I would say that for investors who are looking to add a little bit more risk to portfolios, maybe look at the equal weight benchmark, take a little bit more value and not just that growth. But I think that small caps need to re-rate a bit further before we're willing to step back in there and take another swing.
David, good to see you.
Thanks for
joining us. Yeah. David Divitz there of JP Morgan Asset Management on the latest in this equity market. Tons of earnings still to come this week. Equities right now positive by 0.1% on the S&P 500. An update on some stories elsewhere this morning. Here's your Bloomberg Brief with Yahira Hackers. Hey, Yahira.
Hi, John. Oil's moving this morning following escalating tensions in the Middle East. A tanker carrying Russian fuel was struck by a missile as it left the Red Sea on Friday, in the most significant attack yet by Houthi rebels on a vessel carrying crude. Meanwhile, the U.S. says 3 service members were killed and 34 wounded in a strike on a U.S. base in Jordan by Iranian-backed militia over the weekend. Tehran has sought to distance itself from the attack. Shares in China's Evergrande plunged 21% before they were suspended from trading. All this following a liquidation order from a Hong Kong court. The judge saying the property developer will be taken over by new management in order to carve up $300 billion in liabilities. As of Friday, Evergrande's dollar notes traded at just 1.5 cents on the dollar. Blackstone is betting big on AI through its $25 billion investment in data center operator QTS. The private equity giant took over QTS in 2021 in a $10 billion deal, and now it's bankrolling the development of new data centers across the U.S. But the project is facing backlash from local communities, many of whom don't want the ugly buildings in their backyards. That's your Bloomberg Brief. John?
Yahara, thank you. Up next on the program, pricing in the Fed's first cut.
You probably do need some more weakening in the labor market. You need growth to slow for the Fed to really get back to 2% in a sustainable way. And we're just not seeing growth really slowing that much.
That conversation is coming up next. You're watching Bloomberg Surveillance Night from New York City. This is Bloomberg.
What happened was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you know, you got to be smart about this.
Live from New York City, 1 hour and about 15 minutes away from the opening bell. Equity futures on the S&P 500 look like this. We're positive by 0.05% on the S&P, and the bond market yields are lower by, let's call it, 3 basis points on a 10-year, 4.1027. Tension in the Middle East, 77.64. Crude is lower. Crude is lower, even with developments over the weekend. Amazing. We're down 0.5% on WTI. Brent crude, 83.14. I want to pick up on one single name. It's Ryanair. Here's the move right now on the screen, just about positive intraday by about 0.5%. We've been asking a question, Bramo. Michael O'Leary in his position on Boeing. If these planes got delayed anymore, would he cancel the order? And he said,
not at all. He'd welcome even more. Honestly, Michael, this is a fantastic story. Basically, Ryanair is putting out the signal, the sort of bat signal, that if anyone wants to sell their Boeing 737 MAX 10 jets or otherwise, he will be there to buy them. If anyone cancels them, he will be there. He says, the price is right. We're very happy with this aircraft. We'd love to get more. So, you know, that's their position.
He's a contrarian character.
I kind of love it.
He does come out and say this. Also, apparently he's saying that United comments last week about Boeing were, quote, stupid. So really a shot
I'd love to
fired
have a
across the
round table
Atlantic.
with Kirby and O'Leary sometime
Let's
soon.
make that happen.
To walk through that. I imagine United don't want to make that happen. Ryanair might. They might have things to say.
I'm sure.
I imagine United don't. Under surveillance this morning, pricing in the Fed's first cut.
You probably do need some more weakening in the labor market. You need growth to slow for the Fed to really get back to 2% in a sustainable way. And we're just not seeing growth really slowing that much. The balance of risks, still, it's become more balanced, but maybe still is a little bit more on the side of inflation risks reaccelerating, which suggests to us that maybe a mid-year cut is more reasonable.
Investors are waiting clues about when the Fed could begin cutting. Citi global economist Robert Sokin weighing in saying this: we rolled forward our call for the first Fed cut by 1 month to June, and we now expect 125 basis points in cuts this year. Citi's Robert Sokin joins us now for more. Robert, good morning to you, sir.
Morning.
Great to catch up with you. Let's just talk about how challenged the dual mandate is at the Federal Reserve at the moment, on both the inflation side and on the unemployment side of things. How challenged is it?
I think the Fed's in a really tricky spot. I mean, if you look at the amount of progress you've had on inflation, it's been really substantial. Core PCE running at target over the second half of last year. But still, if you look at some elements like on the services side, still it's hard to have a lot of confidence that that's going to fall back to target in a sustainable way. At the same time, you're seeing signs that the labor market is weakening a bit. You're seeing strains among lower income consumers, stresses in credit. So you have to start wondering, when's the Fed going to put even more weight on that second leg of the mandate, given that core PCE, as I said, is running near target.
Important market-related question then. Have we seen peak soft landing optimism?
I think we are kind of at that point where, as mentioned, the growth data has been extremely resilient with almost no cost from that fall in inflation that I mentioned. So this is probably that peak Goldilocks scenario. And really the next few months are going to really determine whether that soft landing story becomes the base case or whether we move back into that recessionary scenario markets. And I think you're going to see the Fed grapple with that at the next meeting. They're going to open the door for rate cuts, but also be aware that there are still risks to the outlook.
Dominic Constant was on the show earlier, and he said that the disinflation that we're seeing is actually a leading indicator and is leading some of the weakness that we may see in the labor market. Do you agree with that?
I think it's hard to separate how much of this is demand-driven versus supply-driven. On the one hand, yes, I think that it could be a sign that things are weaker than we expect. As I mentioned, you are seeing some softness in the labor market, and really, that's what we think you need to crack that services inflation. But it may also be that just the supply side has been improving enough over time as labor force supply has been coming back. That's been cooling wage growth, and maybe that's what's helping bring down services inflation. So it's that demand versus supply debate that I think it's really hard at this stage to come down one side or the other.
Do we have an understanding of the economic impact of the Fed's balance sheet, of some of these other aspects of the Fed's tightening program that some people occasionally peripherally reference when they're trying to come up with other reasons to sort of pay attention to every granularity of the statement?
Yeah, absolutely. I mean, we think in the background, the Fed's balance sheet unwind has been pushing up long-term rates. And that's another important story. I mean, it hasn't been the primary story, but you've seen this Fed start to shift that narrative as well. We think they're going to start talking about it more, maybe stop that unwind sooner than expected. That should mean less pressure on long-term rates, and that should also support growth.
Does QT need to end before you start cutting interest rates?
Yeah, that's the difficult balancing act. I think you need to at least signal that they're moving in the same direction. So you can start cutting rates and signaling that you are slowing down the pace of running off your balance sheet. I think it'd be very awkward if they were moving in opposite directions.
You remember last time around, it was like that in reverse. They had to wind down QE before they started hiking interest rates, even though it was pretty obvious they were incredibly late. Why does sequencing like that matter to them so much?
I think here they're trying to learn from their past mistakes. I think that was probably a past mistake. And I think they want to send a consistent message to markets that if policy is going to start moving in an easing direction, that's consistently moving in an easing direction.
Do you think that it's been a consistent message to markets that markets matter or don't matter in order to for the Fed to achieve its ultimate goals? I mean, I was really struck the December news conference with Fed Chair Jay Powell, the fact that he did not come out and push back against some of the easing that we saw in financial markets. Do you think he's going to try to walk that back?
You know, this is a Fed that pays a lot of attention to financial markets, and, you know, as things have been priced, they paid a lot of attention in their communication to either trying to walk it back if they think they need to, or kind of ride into it if they think it's the right pricing. I think what you've seen is a Fed where communication has been in a fair amount of disarray. You saw, at times the Fed chair come out fairly dovish, and then other people within the committee trying to walk that back a little bit. The question is, how much do they do that in January? I think what they do is they recognize that they probably don't want to cut in March, and they're seeing that reflect in market pricing, but they don't want to shut the door completely. So I think the market pricing kind of makes sense for where they are right now.
On Friday, the jobs report, the survey calls for 180,000 jobs created. Where is that number? Where does it have to be to put March on the table for your team?
That's a great question. I think it has to be looked at with the combination of data. So it's not just the job gains, but what's happening with the unemployment rate and wage growth. So for example, if it comes in at 180,000, but you've seen some softening on the unemployment side, and you see wage growth continue to come down, I think that starts to feed into that soft landing scenario, and then maybe that also puts March on the table. And then of course, another scenario B, that's a very weak report, and then the growth side becomes the dominant story, and that also puts a March cut on the table. So it could go either way.
So at the moment, no base case is June start.
Yes.
And we get more than 100 basis points of cuts this year.
Yes.
Okay. So that's the back half of the year, more than 100 basis points of cuts as we start to see the election campaign really ramp up. I'm sure you're getting questions about this from clients. How relevant is the election calendar to your call?
We're getting it a lot, and I think it's a really important question. I think there's an argument to be made that, that December meeting where Chair Powell came out much more dovish than expected, that if he knows he's going to have to start cutting rates this year, why not signal it a bit sooner to get as far away from the election if you're going to start that process? So, in our call, we have the economy going into recession around mid-year, and that sort of dominates the discussion for the Fed, and really they're going to cut if they need to cut. However, it's not a good political scenario to be in, as you mentioned, cutting that much right into election, especially because the closer we get to election, that's really when voters start to form their opinions. And so it's a tricky balancing act in a bad situation.
I'm thinking of that September 18th meeting when they put out the projections. Bramo, we're going to get a rate cut in September, 2 months before we've got an election.
I know it sounds crazy right now, but if the unemployment rate's moving up and we are in a recession, as our call says, then that's really what's going to dominate. However, I think if the economy is much more resilient, then that trade-off becomes much more extreme.
I think it's just going to be absolutely fascinating. Absolutely fascinating. Bramo, you try and avoid the politics, but ultimately the politics brings you in.
Oh, there's no way for them to avoid politics one way or another. All I can say is if we're going to be doing this this general campaign for the longest period ever with a campaign that's already been run before, I mean, at a certain point, they're just like, if you guys have already figured out what you want.
They're in a tough spot. Robert, it's good to see you. Thanks for the update. Thank you, sir. Robert Stocking there of Citi. Coming up next on the programme, Major General Pat Ryder, Press Secretary for the US Department of Defense, on mounting pressure for President Biden to take action in the Middle East. That conversation is just around the corner. Your equity market, 1 hour and about 4 minutes away from the opening bell. Equities totally unchanged here on the S&P 500. Crude lower on the session by 0.7%, $77.50.
I used to have a data point I used to share that 75% of the people had never heard a phone ringing. Just think about it. I didn't say had never used a phone. They'd never heard it ringing. Today, 75% of the African people have a mobile phone. They use one, okay? And we will do the same with the internet in the next 5 years. You know, we will do it as an industry, as entrepreneurs. All we need is the space, and we need investment support, because we are the best investment case for this in the world.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Live from New York City this morning. Good morning. 60 minutes away from the opening bell in New York to kick off a brand new trading week. 3-week winning streak on the S&P 500. Looking to see if we can add to that. Plenty of obstacles in the way. Loads of earnings, a Fed meeting, news conference with Chairman Powell, payrolls on Friday coming up as well. Equities go nowhere on the S&P, going somewhere on the Nasdaq, higher by 0.14%. In the bond market, 2-year, 10-year, 30-year. Shape of things as follows. Yields lower by 3 basis points. On a 10-year, 4.1046. On a 2-year, down a basis point or two to 4.33. And just to round things out with crude at the moment, negative on the session. Session lows, just absolutely unbelievable. We're down 0.6% on WTI to 77.50. On Brent crude, just about holding on to 83. Negative 0.6% even with this developing story over the weekend. Under surveillance this morning, a busy week for markets. The Fed is widely expected to hold rates steady Wednesday, but investors are expecting guidance about when rate cuts could begin. This ahead of the January payrolls report due out on Friday. Bloomberg Economics expecting slower job growth and the unemployment rate to tick up slightly. That's the outlook for the week. In the Middle East, Israeli Prime Minister Benjamin Netanyahu saying significant gaps remain in talks to release hostages held in Gaza. International negotiators looking to broker a deal this week, with current talks including a 2-month pause in fighting. Women, children and the elderly would be released first under the terms of a ceasefire, and Israel in return would release more Palestinian prisoners and allow additional aid into Gaza. And it takes you to our final story, really our top story, and the question mark as to why crude isn't rallying. President Biden under mounting pressure after a drone attack killed 3 U.S. soldiers. Iranian proxies attacking troops stationed in northeast Jordan, but Iran has denied involvement in the attack, the strike presenting Biden with a decision likely to be consequential for his presidency. A choice to punish the perpetrators could put the U.S. in direct confrontation with Tehran. Anne-Marie, that is a big, big issue for this administration this morning.
Absolutely. How is this administration looking at this? Is this a red line, Jonathan, because of the fact that now 3 U.S. service members are dead? It is no longer tit for tat and deterrence. You actually have individuals dead and dozens wounded and some even evacuated from Jordan.
Joining us now to discuss is Major General Patrick Ryder, Press Secretary for the U.S. Department of Defense. General, thank you for joining us. Just an update, if you can, just to begin on the well-being of the 34 wounded. That number has risen overnight. I think the last number we had was 25. Could you give us an update, sir, just to begin the conversation?
Yeah, sure. Thanks very much for having me. As you highlighted, 3 U.S. service members killed at a facility in northeast Jordan along the Syria border. The number of injuries has risen to at least 34. 8 of those had to be evacuated outside of Jordan, all of whom are in stable condition at this point in time. There is the potential that the number of injuries could rise as individuals are further diagnosed, for example, from concussive impacts. So we'll continue to keep the public updated on that front. I do obviously want to offer our thoughts and prayers to the families of those who got the most terrible news over the weekend and lost loved ones, as well as those that were injured.
Absolutely. General Ryder, thanks for being with us. It isn't now the case that the American people need to prepare themselves for more deaths, for more wounded American service members at the hands of Iran and Iranian proxies?
Well, as we've said, and will continue to be the case, we will take necessary action to protect our U.S. forces, no matter where they're serving around the world. I'm not going to telegraph or forecast any potential response from the United States because of this attack, other than to say there will be a response, and this kind of action will not be tolerated. You know, U.S. forces are in this region for one reason only, and that is to focus on the lasting defeat of ISIS. And so, again, we will do whatever we need to do to protect our forces going forward. But certainly, at the end of the day, we are not looking to engage in a wider conflict, merely to ensure regional security and stability.
Does the administration think proportional attacks will change the situation in the Middle East?
Well, again, you know, what we're going to do is we will take deliberate, appropriate action. Our focus here is not to broaden a conflict from the very beginning. We've been very focused on ensuring that the situation in Israel does not broaden into a wider regional conflict. Unfortunately, what you have here are Iranian proxy groups that are exploiting the situation and conducting these types of illegal attacks against forces that are in the region to actually preserve peace and stability. So again, we're going to do what we need to do to protect our forces, while also cognizant of the fact that what we don't want is a wider regional conflict.
But would you consider what happened over the weekend, given the fact that in Jordan, this is a facility about terrorism, this is a training facility, we have Americans dead now. Is this now a red line for the administration with Tehran?
Well, look, again, as I highlighted, any attack against U.S. forces is unacceptable, and certainly the loss of 3 of our warriors is something that saddens us all, and we will respond in a time and a manner of our choosing. But again, our focus in the region is not to be there to widen conflict or to create more instability. It's the opposite. So again, we will take necessary action to protect our forces while also working toward that end of regional security and stability.
General, you said that any attack on our troops would be unacceptable. There have been more than 150 attacks on troops in Iraq and Syria since October 17th. How much do you think that what you've done so far, what the administration has done so far, has effectively subdued additional attacks, has sufficiently protected some of these troops?
Well, to your point, there's been over 150 rocket and UAV attacks, and to this point, those air defense systems have worked extremely well in terms of protecting our forces. You know, we're taking a look at this situation here and how this UAS was able to strike this facility and kill and wound U.S. service members. But again, everywhere that we have forces, we're going to take all necessary measures to protect those forces.
Is this an act of war by Iran?
Well, look, it's certainly a horrific act, and it's certainly something that's unacceptable, and we will respond appropriately. But if we take a step back here again, the United States' focus is not to go into these regions to instigate war and escalation. Our focus is to work with regional partners and allies to ensure security and stability. That's why these forces were there. You all remember about 10 years ago when ISIS was 24 kilometers outside of Baghdad. We don't want to go back to those times. And so that's what our focus is. But when our forces are threatened and when they're attacked, we will take appropriate action.
Who conducted these attacks? Can we just start there and really get into the detail of that? General, who were the perpetrators behind these attacks?
Yeah, so what we know right now is we are very confident that these attacks, this particular attack against this facility was by Iranian-backed proxies. We're working through the actual attribution piece right now, but of course it carries the signature of Kataib Hezbollah, which has conducted attacks in the past. But this is something that we continue to look at specifically.
And when you look at this, just for people following this and listening to what's been developing in the Middle East over the last month or so, how big is the difference between those groups and Iran themselves?
Well, for a long time, Iran has used proxy groups around the region to enable itself to have plausible deniability, enable itself to implement policy, and importantly, to essentially try to expel the United States and other countries that are at odds with its own policies and views from the region. And so this is, in a large part, what you are seeing in Iraq and Syria is that these proxies, and to a degree Iran, exploiting the situation, the tensions in the Middle East in an effort to try to expel the United States and the coalition from Iraq and Syria. And again, those forces, particularly in Iraq, are there at the invitation of the government of Iraq to assist in the lasting defeat of ISIS. That is the mission that we're there for, and that's what we continue to remain focused on.
Does Iran have plausible deniability this morning?
Look, we know that these groups are backed by Iran with the support of Iran. They organize, train, and equip these groups, and we will hold them accountable.
You will hold Iran accountable or these groups accountable? And I think, Major General, as you know, this is the issue. Which one is it?
Look, again, I'm not going to telegraph or forecast our response. We know that Iran is behind these groups. We're not seeking conflict with Iran. We don't seek war with Iran. But again, we will take necessary measures to protect our forces, and we will respond in a time and manner of our choosing.
I think we understand that's the position of the government this morning. So, Major General, forgive me for following up on this, but I understand the U.S. doesn't seek war with Iran. Does Iran seek war with the U.S.?
Well, look, I'm not going to speak for Iran. I'm not an Iranian government spokesperson. We know that their actions and their malign activity around the region are certainly contrary to peace and stability. But we will continue to remain focused on our goal, which is regional peace, security, and stability. But again, if our forces are threatened, we will take appropriate action. We will ensure that those forces will be defended.
General, we know that Lloyd Austin is expected to return to the DOD today. Can you just give us an update on his health after he was missing for about a month outside of the Pentagon?
Well, I wouldn't say he was missing. We've known where he's been. But yes, he is expected to return to the Pentagon today, and we'll be working from here. We'll be hosting a bilat with the NATO Secretary General a little bit later this morning, and we're certainly looking forward to him coming back into the Pentagon. As you saw in our statement last week, he continues to recover well. His prognosis is excellent. He does continue to have some physical therapy associated with some lingering leg pains, but he's doing very well.
Besides the NATO Secretary General, what kind of meetings is he expected to have, or potentially has he already had, with Congress to build some sort of bipartisan support, coalesce around an idea of what the policy should be going forward when it comes to this issue that Jonathan's talking about on how to deal with Iran and their proxies?
Well, the Secretary has been actively engaged with multiple leaders to include the White House, with the U.S. Central Command, with the Chairman of the Joint Chiefs of Staff, and of course maintains regular contact with Congress on a variety of issues. Look, we all understand the serious nature of what we're dealing with here. Again, working very hard to prevent a wider regional conflict while at the same time ensuring that our forces can operate safely and securely. And so that will continue to be a main focus going forward. The Secretary is, of course, actively engaged on all those matters, as well as other issues around the world, to include Ukraine and the situation in Gaza.
Major General, appreciate your update this morning, sir. Hopefully we can continue the conversation through the week ahead. Major General Patrick Ryder there on developments in the Middle East. I think I could speak for all of us. Our hearts and minds are with the families affected by the events over the weekend, and now it's about a response. Anne-Marie, what is that response going to look like?
That's the question we asked him, and he didn't want to forecast it just yet. The question is whether or not the United States is going to do a response of deterrence and defense or an actual attack against one of these proxy groups. And I'm not just talking about taking out their missile equipment and degrading how much they can strike American individuals or vessels going in and out of the Red Sea, but actually going after a senior leadership position to send a message.
Well, the senior leadership of who? And I think that this is what you were asking about. Is it from some of the proxy groups, or is it Iran directly? How do you have a tit for tat where you don't cross a red line that you don't know what it is, when neither group really wants full-out war, but both group really is, I guess, trying to escalate on a sort of smaller scale levels? It's a very difficult situation to get your hands around.
Super, super complex. Continues to be. That's the latest on the Middle East. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. Amazon will back out of a $1.4 billion deal with Roomba maker iRobot after a veto threat from the EU. European Council Vice President Margaret Vestager told Bloomberg earlier this month the burden was on the companies involved.
In any merger, it is so that if we have concerns, it is for the businesses either to address these concerns by debunking them or by addressing them by coming up with remedies that will solve the problem. And if a company say we will not come up with remedies, well, then of course we expect that they have good arguments.
The EU warned Amazon would be tempted to demote similar products on its marketplace. Amazon is expected to pay iRobot a $94 million termination fee. In the wake of the announcement of iRobot, the CEO is stepping down and the company is cutting jobs. Shares in Philips fell after the company announced it's suspending sales of sleep apnea devices and ventilators in the U.S. The Dutch manufacturer making a deal with the FDA over its faulty medical equipment. Speaking to Bloomberg, Philips CEO said the company doesn't see any notable harm done after extensive tests done on the devices. Still, Philips is facing thousands of lawsuits. U.S. and Chinese officials are set to discuss the fentanyl crackdown. High-ranking members of the DEA, Homeland Security, and more are set to meet with their Chinese counterparts on Tuesday. It's the first sit-down meeting following President Biden and President Xi's November pledge to renew counter-narcotics operations. Biden is eager to make progress on the issue, with opioids and border control becoming two hot-button issues in the 2024 election. And that's your Bloomberg Brief. John?
Yahira, thank you. Coming up on the program, it's bigger than the market cap of most benchmark indices worldwide. It's 5 names in America reporting earnings, $10 trillion of market cap over just 2 days, Tuesday and Thursday. Up next, big tech on deck.
When you think about what has been holding up the market, has been propelling us higher, it's those big tech companies.
That's next on the program. You're watching Bloomberg Surveillance.
Regional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it, Peacock?
Yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was and when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Stocks on the S&P 500 totally unchanged. The opening bell 43 minutes away. Yields are lower by 4 basis points, 4.0969 in the commodity market. I just keep scratching my head every time I see it. We're down by 0.75% on crude, 77.45, even with the tension in the Middle East. Under surveillance this morning, big tech on deck.
When you think about what has been holding up the market, has been propelling us higher, it's those big tech companies because they really have an outsized influence, not just in terms of price performance, but in terms of earnings. So we certainly do hope that those companies deliver.
Earnings from 5 of the magnificent 7 stocks due out this week. Microsoft and Google coming tomorrow, ahead of Apple, Meta, Amazon on Thursday. Mandeep Singh, Senior Technology Analyst at Bloomberg Intelligence, joins us now for more. Mandeep, these stocks have had quite a run, haven't they? Are these earnings going to back it up?
I think so. And look, in the case of Microsoft and Meta, the top-line growth expectations are the highest. You compare it to Apple, flat top line. So clearly, you know, there is a divergence in expectations. The key for me is how much incremental revenue is Meta going to generate from Gen AI or Microsoft? In the case of Microsoft, they're the only ones who have quantified it's 2% from Gen AI workloads. It'll be interesting to see how much they ramp up their CapEx and what that would mean in terms of top-line expectations going forward.
So let's pick out Meta. We used to say you can't cut your way to growth. Meta's got different ideas, doesn't it?
I mean, look, their business model is such where they can cut a lot, which they've shown in the past year. And, you know, if they keep launching new products, the core business, even though they have engagement issues, they've been able to ramp up ad loads. Look at your ad feed for the Blue app. It's full with ads. And still they have 2 billion users logging into the app every day. So clearly, it is a sticky product, and they're able to pull that lever where they increase the ad loads, lowered the cost base, and that's what's driving the stock here.
When it comes to Meta, and to some degree Apple, and not so much, we'll get to Microsoft and Google in a second, how much are you listening for what they say around artificial intelligence, and how much is that really going to be noise versus some of the advertising that you're talking about and the actual revenue-producing aspects of their business?
Yeah, so to me, Gen AI monetization right now is clearly around workloads. You want to run your large language model workloads on these clouds. And these clouds are the ones who are buying the NVIDIA GPUs. So there's a real inflation on the chip side. In fact, Microsoft did say their gross margins is going to take a hit, because they can't match the revenue that's being generated from these workloads. But these workloads are sticky. These are multi-year workloads. So once they have the customer, if the margin expansion will happen.
Hold up. Are you saying that NVIDIA's gain is Microsoft and Google's pain right now?
All of the software companies. Software is an 80% gross margin business. What is happening with the inflation in GPU prices is it's going to hit all the software guys who rely on chips because they have to pay up more. The gross margins will come down. Question is, can they pass it to the customers? And the answer right now is Microsoft has the best mousetrap because they have the OpenAI partnership. So they give you the best cloud to run your LLM. And over time, they'll be able to monetize it. The other ones are still figuring out, do I use Llama, open source approach? Do I use Anthropic? And that's something to find out.
Where is Alphabet in this race? I think if you'd asked us a couple of years ago who would win here, I think a lot of us would have said Alphabet and Google. Where are they?
Well, so Alphabet has that vertical integration where they have their own large language model, Gemini, and they want it across their cloud portfolio on the devices. Think of Android. So they want to bundle the large language model with your Android ecosystem. And I think it's a very good strategy. The problem they're having is the search business is getting attacked from all angles. Everyone, look at Bing, what they have done. They have partnered with Meta. They have partnered with every company out there to provide search because large language models are not real-time searches. You need real-time search component. That's coming from Bing.
And yet, when I want to find out news about Bing, I probably search on Google still, because Google, for me, is just a superior product, Bramo.
I recently Binged.
Did you? How did that work out for you?
Actually, I didn't enjoy it as much as Googling, and I did the Bing. And
personal reviews that count here.
I don't think I've ever Binged. I need to do it. You do, because it's the default on any PC. So that's the reason why they get some attitude. They get some eyeballs. I am curious, though. Google is potentially really in trouble. I mean, that's what I heard, at least from other tech people in Davos, who were saying, you know, this was actually someone who actually could be disrupted. Do you believe that?
I mean, I think the narrative right now is Google is getting attacked because they have the 90% share in search. Everyone feels the value of large language model is in search and summaries. So technically, yes, their business model should come under pressure. But when you look at the engagement metrics, Google still has the engagement on Chrome, on mobile. So clearly, there is a threat that someone like Perplexity is an app that has become quite popular because people feel it's a better way to summarize content. And in some use cases, you are going to use a large language model instead of a Google search, but that doesn't take away the overall use case of search. And I think that's where Google definitely has an advantage.
You know, we haven't mentioned Apple. And I find it interesting because right now we're talking about AI and we're talking about search and advertising. Does Apple belong in the Magnificent Seven, or should it be really lumped in with LVMH?
I mean, Apple's reliance on iPhone is very obvious here, that the fact that they don't have a cloud pivot or anything else, it's really device-based, but they still own the distribution. If you have to roll out your large language model or new search, you need that distribution that Apple has. So they will still call the shots. Problem is, they would love to buy a company for a large language model. M&A would be a great strategy, given there are so many large language models out there. They haven't done that. Anthropic, or all these companies that, Amazon has partnered or Google has had a minority investment in, and there are a number of large language model companies. So they need to beef that up. They have the distribution. The users will use whatever they offer because it's vertically integrated.
We've talked lots about market caps. Can we just finish on valuations? Just how stretched are valuations for some of these names?
I mean, look at what happened to Tesla. Everyone thought they would keep growing over 20%. When you have that kind of a miss where they lower the expectations, the multiples compress. And so right now, all these companies are priced for double-digit growth. And we know they can't keep growing at double-digit because the math doesn't work at their size. The top line can't grow double for Apple. That goes in their favor.
Okay.
But clearly, Meta, 21% top line growth. Can this sustain if they keep showing more ads on the feed?
Is that the lesson from earnings season so far for you, that we've rewarded beats maybe less than we've punished misses?
Oh yeah, the bar is much higher this earnings season than it was last time. And with the multiples where they are, they better beat. I mean, that Gen AI component is huge for Microsoft. They better come out and say it's going to contribute at least 3% to our growth.
Mandeep Singh of Bloomberg Intelligence. Mandeep, good to see you. Front page of Barron's this week, and Satya Nadella crushing it at Microsoft. Bar's pretty high for them. And I'm with Mandeep, relative to, say, Apple. We got 2 downgrades, remember, to start the year. Apple struggling, even after a massive run-up in the stock, something like 48% higher in 2023.
Yeah, but everybody's still going out to buy their iPhones, and they're captured in the ecosystem. I do think the most interesting one to me is going to be Google, because you asked the question, Alphabet, how much can they really compete with Microsoft, especially if they're being squeezed with NVIDIA chip prices and trying to pass it along to some of their cloud customers?
What does it say about Bing that you actually have to say that I binged? And that's like a thing, that you went on Bing once and searched for something.
I just like saying
what does that say?
I binged. Is it I binged or I bing? I binged.
I'm sticking with Google.
The fact that we're still trying to figure this out.
No, I know, but
there's a steep hill to climb.
But it's the default search, and at a certain point, if they try to get it to be a better kind of look, maybe they'll switch the name to, Moogle.
Moogle. Okay. Thanks for that, Bramo. That kind of coverage coming up later this week. Don't miss it. Coming up through the week, those big 5 companies reporting Tuesday and Thursday, a Federal Reserve decision Wednesday, payrolls on Friday. Coming up tomorrow, through tomorrow morning, Brian Levitt of Invesco, Jill Castile, CEO of Citizens Bank of Edmond, Nikolai Tangen, Deutsche Bank Investment Management CEO, and Stephanie Roth, Chief Economist at Wolfe Research. All of that and a whole lot more from New York City as we kick off a brand new trading week. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I'm part of the baby boomer generation, and this generation is now increasingly dealing with problems relating to Alzheimer's, dementia, and so forth. Not particularly my age, but maybe some people my age, even younger, but obviously in their late 70s, 80s, and 90s, more and more we're reading about Alzheimer's. Is this an epidemic that you can't really do anything about, or is it something we could deal with in some way?
It's a real challenge for a lot of families, mine included. I have a 90-year-old grandmother at home who's struggling with dementia, and providing care for her has been a real challenge. And for my family, we love her dearly. We want to be there for her, but it's painful for us to see the toll dementia has taken on her. So this is rightfully, a concern for families across the country. We're investing a lot in studying dementia, to not just Alzheimer's, but other forms of dementia, to understand what's driving it. But very interestingly, there's also some research that's taking place lifestyle research, if you will, on the impact of diet, of social connection, of physical activity, and sleep on dementia as well. Dean Ornish, professor at the University of California, San Francisco, has been actually one of the key folks, who has been leading some of that research on the impact of lifestyle and dementia. And this is a promising area.
Thought maybe I should go do something else. I can't do anything better than I'm already doing. I've already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
From New York City for our viewers worldwide, I'm Manus Craney in for Jonathan Farrow. Caution on the markets. The risk is a wrecking ball arrives on risk from the Fed, from tech, and from that jobs report.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Farrow.
Coming up on the show, a cautious start to a blockbuster week for earnings. Traders looking ahead to the Fed and U.S. jobs report. And President Biden faces mounting pressure to confront Iran. We begin with the big issue, gearing up for a huge week ahead.
We're in a situation where there are a few more nerves in the market. An important week. The Federal Reserve.
Its payrolls. 40% of the S&P market cap reported.
All the mega cap companies, Amazon, Apple, Alphabet report.
When you think about what has been holding up the market, has been propelling us higher, it's those big tech companies.
From a profitability perspective, tech is likely going to be the sector that can deliver.
When we look ahead to the Fed,
officials will more clearly outline how they're thinking about rate cuts over the next year.
Is this a Fed that's looking to cut rates as early as March, or is this a Fed that's waiting to kind of take their time?
I think he's going to say that there's been progress.
There are some signs that because inflation has come down so much that we should already begin to see soon the Fed begin to cut rates.
One of the key pillars to economic activity remains the labor market.
Under the surface, the labor market is cooling. That's a lot of event risk for this week.
There are many swords of Damocles across these markets. JP Morgan's Jack Manley weighs in on the road ahead for the markets, writing this. The recovery thus far has been narrow and driven by multiple expansion. We're looking for a broadening out, agnostic to sector or style, with the emphasis on security selection. My guests this morning are Jack Manley, who uttered those words, joining us alongside Morgan Stanley's Brian Weinstein. Okay, so here we are. You want to go for breadth, Jack Manley, but there's a certain constraint on you. You've got to have a certain proportion of Mag 7. How much breadth do you want to take? Good morning.
Well, good morning, Manus. And, you know, the good thing about this problem that you pointed out here is that there's nothing wrong with the Magnificent Seven, right? We like these large, growthy technology names that are domiciled here in the United States. You know, I don't think anybody would look at you and argue with a straight face that technology will be less important in a decade from now, that artificial intelligence doesn't have the potential to fundamentally transform the world. I think the big question that we're all asking ourselves right now is what to look for over the next 12 months, and have some of this future innovation kind of been pulled forward over the last 12 months. when I think about the broadening out of the recovery, yes, there has to be this emphasis on security selection. I don't care a whole lot about style boxes at the moment, but the thing that kind of underpins the overall story here is going to be a bias toward quality. And quality in this case, Manus, means things like dependable earnings growth. It means strong balance sheets. It means reasonably attractive valuations. And that emphasis on quality is going to be linked directly to the interest rate environment. You know, a lot of talk this week about what the Fed may be doing, whether they cut in the first half or the second half. The general story is that rates are moving lower, but we also know that they're not going back down to zero anytime soon. And if money isn't free, we have to be more thoughtful about how we're allocating our capital. So some of that Mag 7 in the returns this year is totally fine, but we want to look beyond that, given where the interest rate environment is going.
Okay, so there's look, the daily conundrums of when will the Fed cut, how much will they cut by? Brian, good morning, good to see you. For you, what would breadth and taking a slightly broader perspective on risk be?
Totally agree. I mean, you can see it in the fixed income markets, right? There's been a broad-based rally in high yield spreads, IG spreads, and so I think you are seeing a broadening out of the rally. And AI is not only going to help the Mag 7, it's going to help any other number of industries and companies that can survive a non-zero rate environment. So I think with that backdrop, broadening out makes total sense. And rates have probably peaked. The Fed will be easing, I think, in the first half of this year. So there will be more supportive borrowing, even for companies that aren't quite as high quality as the ones we've seen rally so far in the last year.
I think it just depends on what kind of cuts we actually get and whether they're preemptive or prudent at the Fed. And speaking of which, all eyes will turn to the Fed on Wednesday. As we brace for the decision from the Chair Powell and his team, the news conference will follow. Mike McKee will be locked and loaded and ready to go on this. Mike, so what are the nuances that I need to focus on?
Well, not a lot of nuances at this meeting because the Fed has pretty much told us what they're going to do. We can expect an unchanged Fed funds rate, and they'll probably drop any additional policy firming language to make themselves neutral and not leaning towards higher rates. Talking about QT policy ahead, that's what the market wants to hear. Are they discussing any kind of taper? And then any hints from Jay Powell on rate cut timing. Here's the debate that's out there. The case for holding rates steady. You mentioned it earlier. We're seeing GDP rise. We're seeing consumer spending stay strong. And the white line there is the Atlanta Fed wage tracker. As you can see, it's still elevated, 5.2% gains for people on wages. Are we going to have higher inflation because people are still getting a lot more money and the economy is a lot stronger than people thought? Wall Street tends to think so, or at least that's the bet right now, that we won't see it because they're not betting on anything in March, but May, June, and July. By the time we get to July, they think we'll have 3 cuts already done. But the case for cuts is this, that at this point, because the Fed has raised rates and inflation is going down, real rates are moving up, and the Fed doesn't want to make conditions any tighter, even though the economy is strong. So in order to keep financial conditions about the same, they will cut. That's the debate out there, and that's what we'll be asking Jay Powell about on Wednesday, even if we don't get any moves from the Fed on Wednesday.
Okay, Mike, thank you very much. It's still a towing cost for the market whether we go 50-50 on Wednesday. Jack Manley, Brian Weinstein is with me to debate this. So 3 cuts by the market by July, which some would say is prudent, practical, and protective to the landing. Jack, would the 3 Ps stack up for you? 3 cuts by July?
I like the 3 Ps, Manus, but I don't agree with it necessarily. I don't think it's prudent. I think it's aggressive, and I think it is largely unnecessary. You know, this is an economy that is very clearly slowing down, but we are not slamming on the brakes at the moment. We don't need that extra stimulus that would come from a lower Fed funds rate, and I think the Fed is going to be very comfortable holding interest rates where they are right now, looking for further improvement, not just in inflation, but in particular on the wage picture. And we're going to get a little bit more clarity on that this Friday. I am very much in the camp that our first cut is going to be a back half cut. I'm looking for 75 basis points lower on the Fed funds, maybe a little bit of upside risk to that number there, but not by a whole lot. And the problem there is that the market pricing in all these cuts ahead of time may be a little bit disappointed. We could end up with some multiple compression if they don't get what they're looking for out of that Fed rhetoric.
And if we take it across to you, Brian, I mean, here we are they've got all the reasons in the world to go ahead with these cuts. PCE is being well behaved on a 3-month, on a 6-month basis. It's acting beautifully. You've got a fairly robust consumer, but they have got the cover to be prudent, don't they?
Listen, I think I've been in the May camp. I'm moving more to the March camp. I think they're only going to do 100 this year. So, and I totally agree that the market may be disappointed when it's all said and done. But I think what the Fed wants to do here is just say, listen, if neutral rate is somewhere between 2.5 and 3.5, and inflation is slowing, then you don't stay at 5.5, right? You have to start to lower the rate. And if that's true, it's not going to be more true in May, right? It's true now. In fact, inflation could start to tick up by the middle of the year. So I think you get them front loaded. I think 75 in the first half of the year actually makes sense, with not too much more to follow. So we end up in the same place, but I think those rate cuts come sooner.
Brian, I'm drawn to your view that we get a change in leadership in energy banks and slightly more defensive. I mean, are you waiting for some kind of a mini drawdown, a mini draw for breath in these markets before you step in and load up in a change of leadership?
Yeah, it's been a rough strategy to wait for dips in this market. No, listen, I don't think that you're going to get...
It's called weaponized FOMO. It's called weaponized FOMO, Brian. I have it on good authority.
Yeah, that it feels like that. No, I don't think you need to get. I don't think you need to get big dips. I think you're seeing idiosyncratic pain when companies miss or disappoint. But no, I think this could broaden out if the Fed does ease early. I think this could broaden out without I mean, obviously you can get some dips here and there, but I don't think you're going to get super cheap valuations if the Fed plays this the way the Taylor rule says that they should.
And, you know, Jack, if we take it back to you, you say large caps are more expensive relative to smaller, but then you would say large caps can play they can take a lot more rough and tumble, a lot more of punches relative to the small caps. So you're not a buyer of value relative to growth at this stage, I take it.
Not a whole lot, Manus. I mean, I do like that large cap story right now. Yes, they are expensive, but I think in particular when we look at the composition of the large cap index, it is a duration heavy index. It is an interest rate sensitive index. It is very long-term focused because it is technology biased. And what that means is that investors aren't buying these names for what they're going to do over the next 12 months. They're buying these names for what they're going to do over the next 5 to 10 years. The valuation environment doesn't really scare me a whole lot. But beyond that, there is a lot of quality behind those large cap names, right? We look at the composition of their debt. A lot of it is fixed rate, not floating. A lot of it matures after 2030 as opposed to before it, which is in contrast to what you're seeing at a small caps. These names are profitable, and if they have good balance sheets, they're able to absorb some of this wage pressure that we've been seeing and will likely continue to see on Friday. So large cap, I do think, still makes a whole lot of sense. And you know, on the value versus growth story, I'll bring it back to that earlier comment. It's not one or the other. It is going to be both. I guess if I had to pick one style box, if I had to get pigeonholed, I'd lean more into those value assets, those cyclical parts of the market. But there are, I'm sure, plenty of high quality, reasonably valued, growthy names out there as well. That's why this emphasis on active management is so important as we move through this year.
Jack, you make me chuckle inside that you remind me that investing is in theory, you know, a 3 to 5 minimum year horizon. In which case, it's only when age hits you, gentlemen, that you begin to realize what 5 years forward means. Briefly to both of you, would you pick off some 10-year paper at 410? Is that a reasonable return? Because I haven't seen yields like that. I missed the 5% boat. Should I pick up the last 4 handle? Jack?
On me, yeah, I think so. We had such a rally in the bond market in the last couple months of last year. I think the duration trade is mostly played out. I'm looking for coupon this year, and that's a pretty decent one.
Clip me up. We'll come back to you, Brian. Don't worry. There's more work to do. Jack, Brian, stay with me. Your morning selection of risk on Bloomberg. Joining me now to look under the hood, ahead of the opening bell, it is Abigail Doolittle. What have we got, Abby?
Well, we have the U.S. futures basically flat, but beneath that benign surface, Manus, we do have quite a few movers, starting off with the shares of SoFi. They are soaring, heading to their best day potentially since July of last year. The online bank posted its first ever profit of 2 cents, a small profit, but nonetheless better than the loss expected. And they also talked about how 2024 is to be a transition year of growth toward financial services, a little bit less lending. American Airlines up 1.3%. Citi has upgraded this stock to a buy from a neutral on the airline's ongoing deleveraging process. And then finally, iRobot plunging down 19%. Amazon has dropped the $1.4 billion deal on a clash with European regulators who were threatening to block the deal. This stock, since that deal was first announced back in August of 2022, well, Menace, it is now down about 72%.
Okay, thank you very much, Abby. Let's see how we open today. Coming up on the show, it is a big week for big tech.
When you think about what has been holding up the market, has been propelling us higher, it's those big tech companies.
We take a look at the 5 heavy hitters on the slate this week.
I think this will probably go down in history as one of, if not the largest financial crime ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
On the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
When you think about what has been holding up the market, has been propelling us higher, it's those big tech companies because they really have an outsized influence, not just in terms of price performance, but in terms of earnings. So we certainly do hope that those companies deliver.
In case you hadn't noticed, it's going to be a big week for tech. You got Microsoft, Apple, Alphabet, Meta, Amazon, all reporting. Now, the 5 of them have a combined market value of $10 trillion. Joining me now is Katie Greifeld to go through what we can expect. Katie.
I'm going to say that one more time because I think it's amazing. You think about Microsoft, Alphabet, Meta, Amazon, and Apple, $10 trillion in market cap, all due to report between Tuesday and Thursday. Like you said, it's going to be busy. So let's talk about positioning here, because when you focus on just the Magnificent Seven, you have 5 represented here in that grouping. You take a look at the group's average 30-day implied volatility. It's actually been rising compared to the VIX, which is going absolutely nowhere. But then you take a look at the volatility on these specific names, and it's pretty historically cheap, man. It's most dramatically in Amazon and in Meta. If you take a look at Amazon options, they implied a 6.2% one-day move after earnings. That compares to an average move of about 9%. Then you focus on Meta, it's even more dramatic. You have options there implying just a 6.5% post-earnings move. That compares to 14.9% on average. So it's interesting here that you don't see traders really reaching for protection, even though a lot of these names are trading close to or at their all-time highs. You remember Microsoft last week hitting $3 trillion in market cap. Of course, we're going to find out soon enough whether or not that was the right move to kind of forego insurance here. But of course, it's going to be very, very consequential these next couple of days to figure out how sustainable this big tech rally truly is, Manus.
Yep. Well, certainly, Volatility is cheap, there's no doubt about it. It could take a little bit of a spike later on this week. Katie, thank you very much for setting the stage. My guests this morning are Jack Manley, Brian Weinstein, to discuss these markets. Two things that go through my head when Katie lays out the board of risk, which is, I've had various people come on and they say, I want a little bit more cash. I don't quite want to buy volatility because it's a waste of money. But how do you protect yourself for a mini jolt in this market? Jack?
Well, I think the first thing is to step out of cash, but you don't have to take a whole lot of risk on that front, man, is to find some pretty attractive returns. I mean, we look at high-quality, intermediate duration fixed income as almost a slam dunk trade this year. Yes, a lot of that return happened in the last couple of months of last year, but with where coupons are right now, I still think you have a pretty decent floor in terms of return potential without taking on a whole lot more risk than maybe traditionally associated with a cash-like investment, if you want to call it that. But I think it also is about finding those names in the S&P 500, call it, that are now actually punching above their weight class from an earnings contribution perspective. You know, this is a very important week for earnings, of course, because these are the largest names in the index. It's also because this earnings season has been pretty disappointing, and earnings in general have been somewhat disappointing. You know, we look at the 10 largest names in the S&P 500. They are bigger than they have ever been in history, accounting for around a third at market capitalization, but they're only contributing about a fifth of overall index earnings. There's a disconnect there, and that's reflected in those multiples. So finding those other names out there that are actually punching above their weight class from an earnings contribution perspective, that's another element of this strategy as well.
It's interesting because you put context around what's going on below that index hood level. Brian, if I said to you, are you disappointed with the earnings season so far, or where do you see the other opportunities?
Yeah, listen, I'm not disappointed. It's hard when you come into January and everyone wants the themes to change, and then you have the same stocks take leadership again, and people get frustrated. But no, I think under the hood, you can see investors are looking to move that cash. I think the way you protect yourself is you do move out of cash a little bit, right? That yield's not going to be around forever. So totally agree on short fixed income. By the way, I'd throw some tips in there. I think real yields are cheap. The Fed wants them lower, so that's one way to play it. And then yes, you have to buy some of the parts of the market, the S&P or whatever index you choose, that haven't participated in the rally as much, that investors haven't chased, that have good earnings. Some of them have great dividends too and great yields. So you can find ways to earn income in this market and find some safety away from just owning the same stocks that have worked. And I do think that theme will play out in the next couple of months.
Can I ask you briefly, we're up against the clock, so I want to get a sense from both of you. I'm always curious. We talk about the flow, the most concentrated stocks, the Bank of America survey, the most concentrated since 2021 on tech. To what extent do you look at flow and concentration risk, Jack?
I think concentration risk is a big problem right now. It's not going to be a big problem forever. This disconnect that we see between earnings and price, I guess you could say, is a temporary one. Those big names are high quality. They will get that earnings growth back. They will get those earnings numbers better. They will grow into those multiples. So for now, it's an issue, but I don't think it's a permanent one.
And Brian, for you, are you bothered by the flow show? I love the flow show. Don't break my heart. Don't shatter my dreams.
No, I don't think it's fascinating, right? And there are examples of when parts of the market have gotten so large and investors have owned them at exactly the wrong time. So that fear is in the back of your head. But no, I think in this case you want it to resolve itself in a positive way. Other companies doing better, catching up a little bit, but I don't think you're going to see a big change in the leadership in terms of the percentage breakdown of the market for a long time.
Look, we're constantly trying to understand geopolitical risk. You've got freight rates rising, the Red Sea tensions rising. I don't want to get lost in the mire of how America responds to the most recent incident over the weekend. But I do want to contextualize your view on the risk of a respike in inflation here in the US as a result of geopolitics, or is it a very European problem? Jack, brief and sweet.
I think it's mostly going to be a European problem unless we see some problems with energy, and then that becomes a global issue that becomes a little bit insidious.
And Brian, for you, wrap it up.
I think you're fine with the back of your mind as, you know, when the Fed does start to ease, is inflation going right back to 2? Is it going to stay down there? I think there's some reasons to believe that late in the year you want to start worrying about that story playing out. For now, it's more of a European issue.
Okay, well, we'll keep an eye on those flows. It's interesting to see the oil market this morning. It did 6% last week, but actually very, very little this morning. And we wait to see what the substantive, if at all, substantive response it is from the White House in terms of blaming Iran on these attacks over the weekend. Jack, thank you very much. Jack Manley, Brian Weinstein. Their thoughts this morning on markets. Coming up on the show, your morning calls a little bit later on. We're going to catch up with Lori Calvasina on her calls in this big week for tech earnings. $10 trillion to hit this slate between Tuesday and Thursday, right here on Bloomberg.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Quick snapshot of what's going on in markets. We know there's $10 trillion worth of equity risk coming down the pike, but you have a quarterly refunding statement. You have a Fed which could pivot even more aggressively to an easing stance. Yields are dipping ever so slightly, but it is the quarterly refunding and the jobs report which can materially move these bond markets. You've just heard from our guests talking about 4.3% and 4.1% as being appealing for them as far as taking in some coupons. Let's roll it over, have a look at the equity market. You'll hear it time and time again. There is $10 trillion worth of equity market cap coming to bear on the market. At the moment, you've got 3 months of a rally, up 18%. Is there any sign of exhaustion of that in the market? NASDAQ is up an 8 to 1%. It is big tech risk that is going to drive sentiment after the close of business tomorrow evening. In the meantime, this is what the scribes of Wall Street have got for you. We have Warner Brothers downgraded by Wells Fargo to equal weight with a PT of $12. Lower earnings is the citation. Norfolk Southern is cut at both Morgan Stanley and Stifel. Analysts flagging that the company needs to catch up with its rail peers. And finally, Colgate-Palmolive, raised by Raymond James to outperform. The analysts see the upside opportunity for the household products this year. Have you bought a tube of toothpaste recently? The price is incredible. There you go. Colgate-Palmolive up 0.6%. Coming up, how rich is Lori Calvasino's blood for a little bit of tech, or is there breadth on the way? What does she expect from the earnings this week? Nearly 40% of the S&P market has reported. The results are in. My last guest says it was slightly underwhelming. Will she agree? On Bloomberg.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited, finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
DOJ or other authorities
Could face bigger challenges next.
It was going to keep bringing World Cup. This is a 3
as the economic picture.
covering the intersections of Hollywood, Silicon Valley, and beyond.
We bring you American culture and markets here. The Gronk from the Patriots. I learn something new every day. There you go, Flutter.com. They're on the move. You've got equity markets up 18% in the past 3 months. We know it's going to be a big week for tech, but there's also Fed risk. What will the Fed deliver in terms of perhaps a dovish pivot? There we are. We're rolling over to the cash opening. You can see he draws a cry. That's not for me, that's for him. Equities are up, as you can see. Can we hold on to the gains? And a number of stocks that are going to be on the move. We'll go through those in just a moment. Keep an eye on the euro. The euro is down, the dollar is bid, because you have Francois Villeroy de Gallo again commenting over the weekend about the proclivity for rate cuts in Europe. Will they go first? Will they do more? Is April on the slate? We will have to avoid two risks that become balanced. So they are talking more about the timing of rate cuts in Europe relative to the US. 10-year yields trade flat at 410, and crude is down 0.75% despite the heightening tensions and geopolitical risks. Will Kennedy will be with me very shortly to discuss the nuances of the oil market. Two stocks that we are watching, iRobot and Amazon, the tech giant, dropping its deal with Roomba, the maker, after clashing with EU regulators. Abigail Doolittle is with me. I think I have a Roomba.
Do you really? Maybe I should get one, make life a little bit easier on the weekend. Relative to iRobot, it's a rough day. The stock down more than 17%, down 4 days in a row over that time period, losing about 25%. But this is not the only news. The CEO has stepped down, and they are cutting 31% of their workforce. Now, clearly the big news, though, is Amazon dropping the $1.4 billion deal. This after, as you mentioned, EU regulators questioning or threatening to investigate whether or not it would keep away competition from the marketplace. And this is a sign of the intense pressure that Amazon is under to not create a lack of competition. So instead of answering to some of the questions in the investigation by the EU, they are choosing to walk away and instead pay iRobot the $94 million termination fee. This is similar to a decision made by Adobe walking away from a $20 billion potential acquisition that did not happen, of startup Figma. Another reason to not go through with the deal, though, is that recently, and over the last year or two, Manus, iRobot has really seen a reversal of fortunes after the pandemic boom of people being home, not so much sales, a lack of profitability. The stock, since announcing the deal back in August of 2022, is now down more than 75%.
Okay, Abby, thank you very much. Shifting tides of the EU on regulating deals. Let's turn to the chips, and never far from our mind. Elon Musk says he plans to buy semiconductors from AMD as the EV maker loads up on AI hardware. Ed Ludlow, good day to you. Back in your hometown. What's going on? What's Elon buying now?
Well, this is curious because, as you can see on your screen, AMD is now softer by 0.9%. It had been up 1.5% in the pre-market, and that was partly a gain driven by a single word, which is yes. Elon Musk was asked on X, the social media platform, will Tesla buy AMD chips? And he just responded saying simply yes. But it was in the context of some commentary from Musk about their $500 million spend on NVIDIA hardware, and which is a reference to not just their H100 GPU, but DGX or HGX, the server design that goes into data centers and powers both LLM training and on the inference side as well. There were some other catalysts in the market that are kind of interesting. There were 2 stock upgrades on AMD, which is continuing to be down 0.9%. One from Susquehanna, which is bullish on the prospects of AMD's AI accelerator. It's the product that they want to compete with NVIDIA on, but it only just started shipping in volume in the quarter gone. And similarly from Morgan Stanley raising its price target, also bullish on the long-term AI opportunity. I'm trying to work out what's going on. You look on the Philadelphia Semiconductor Index, most of the names there are in the green, and it's a pretty even split of those names in the green and in the red on the NASDAQ 100, but AMD's decline's accelerating 1.4% now, having been 1.5% higher in the pre-market. Happy Monday.
Happy Monday, go figure. You know, there's a couple of analyst notes out there as well to consider. Ed, thank you very much. Let's stay with the chip makers. The Biden administration expects to announce billions of dollars in new subsidies to chip makers that include Intel. Now, this is according to the Wall Street Journal. Katie Greifeld is side by side with me here. Katie, what are the details here? What's the ambition?
Well, according to those reports, of course, those grants could be awarded in the coming weeks to the tune of billions of dollars, as you say. And this is really part of the U.S. CHIPS Act. You think about the goal of that act, and it's to bring chip making back to the U.S. and also counter China's growing chip making industry. So that's the ambition, and that's giving a little bit of a boost to Intel, or at least it was pre-market. You can see it's down now, and that's because Intel is really fighting against its own fundamentals here. Remember, we heard Intel's earnings report last week, and it gave a disappointing first quarter forecast for both sales and profit that really sparked fears that this long-promised comeback bid for Intel has been derailed at some point. Now, you have the PC business when it comes to Intel, that's recovering, but when it comes to data center processors, you see that demand is weakening there. You add it all together, and that translated to a nearly 12% plunge for Intel on Friday alone. Of course, the CEO, Pat Gelsinger, he told Ed Ludlow and Caroline Hyde last week that reaction was overstated, but that's the overhang today. You can see Intel bouncing back and forth here, of course, even with that potential White House support in the offing. We'll see how this plays out.
Yep. Underwhelmed, and this market will quite literally be vicious with you. Katie, thank you very much. Katie Greifeld there. Turn to the earnings. You've got SoFi reporting the first ever profit earnings, topping out on the estimates. So Foxman is with us. So what have we got? The stock's up 16%, Simone.
Yeah, an enormous surge this morning, Manus, after results that Mizuho called outstanding. The company able to turn a profit of $48 million in the fourth quarter. That's up from a loss of $40 million, and that equates to about 2 cents a share. Adjusted net revenue also coming in ahead of expectations, up 34% year on year, and your membership count rising 44% year on year. Now, SoFi describing this as a year of transition in their earnings statement, where tech and financial services are going to start outweighing the growth of its traditional lending space. So expecting like a 50% compound revenue growth for financial services, mid-20s for its tech platform, which has to do with banking infrastructure. Well, it still sees mid-teens growth in lending, and we saw some of that in the earnings, where originations were really the only thing that kind of missed the overall consensus estimate. But Anthony Noto, the CEO, saying that growth in high-quality deposits has actually lowered the cost of funding for the company, also announcing some new business lines, investments in alternative funds, mutual funds, through its SoFi Invest platform. Now, it's worth noting that shares are still down about 10% roughly month to date, after there were concerns about the prospects of consumer finance. Morgan Stanley had expected, for example, that most of those companies would miss, but clearly not the case with SoFi, and we're seeing the reaction in the market this morning, Manus.
Yeah, a plum move, up 18%. Simone, thank you very much, rounding it up there. Let's stick with the earnings theme. RBC's Laurie Calvasina weighing in on what to expect. Companies have tried to strike an optimistic tone in the first batch of earnings calls with consumer resilience, macro risks, and the theme of normalization emphasize, there's nothing normal about these markets, Laurie, is it? 18% in 3 months. It's record after record. I mean, I'm breathless trying to be enthusiastic about it. How priced to perfection is this? Or when you look at the PEs, you would actually still say elevated, but you're not alarmed.
Yeah, so thanks for having me as always. I would say from a valuation perspective, I think markets have been fairly priced. If you look at data going all the way back to the 1960s and look at where PE should be in light of moves in inflation, interest rates, GDP, and where those things are expected to be at the end of this year, our model would tell you that stocks ended basically where they needed to be at the end of last year, and there's still, a decent amount of upside through the end of this year. We actually found in the update of that model that we published over the weekend, it's pointing to a bull case of 5,500 on the S&P. That's not my target, so don't get too excited. I'm still at 5,150, but that just gives you a sense of, maybe how much more one of our bullish models has been saying we could actually go, and it would still be rational. I think if you look at it from a slightly different angle, from sentiment, things do seem a little bit more precarious. And so if you look at CFTC data on U.S. equity future positioning on the buy side, we're basically a little bit above highs that we saw back in 2018 and 2020 pre-COVID. If you look at NASDAQ futures positioning, that's back to the 2013-2015 highs on the buy side on a notional dollar value basis. And if you look at the AAII survey, that started to come down a little bit the last couple of weeks, net bullishness, but it's been at a level about 1 standard deviation above the long-term average, where markets are typically flat over the next 3 months. Okay. So I think valuations are okay, but sentiment is a problem.
So you're only leaving me 200 points on the upside on the index. So that must fill you with dread on how to allocate, does it?
Well, look, I think that there is some upside between now and year end. Again, we've got that 5150 target. There are some headwinds we have to work through, right? Expectations for a sluggish economy. I think that's dissipating. If you believe that GDP forecasts are going to continue to move up as they have been since the fall, as they have been since last summer, that would, kind of push you into some of the more cyclical areas of the market, like financials. But I will admit to you, I do think that it is a very uncertain year. And I think that we do have there's a lot of difficulty, I think, with picking sectors at this point in time. We have a few of our favorites, but I think this is the toughest sector picking environment that I can remember.
You mentioned the sentiment surveys, AAII. You talk about the retail investor. We're coming up to that time of year when bonuses will get paid, when people will think about what they want to do with their 401ks, and you're going to get chunks of money arriving. So is March and April a sort of a pivotal period of time on the next evolution of bullishness?
So I think it's interesting that bullishness has started to wane just a little bit. I actually feel, if I look back over, the time I've covered equity strategy on the street, right, and I think about big moves and funds flows to start the year, I feel like those really happen in January, to some extent February, and by the time you get to March or April, it really feels to me like you've run the risk, actually, frankly, of seeing some of those reallocation trades peter out, and then people go back to the same old themes. So I think we'll see what ends up happening. We certainly did see a rush of money into things like small caps and value in the final couple months of last year, and that sort of turned on a dime as 10-year yields started to back up again. I think that, frankly, we're just going to have to be prepared for a whiplash in narrative again this year, the way we experienced last year.
What does whiplash mean for investing?
Whiplash means that you have to be diversified. And so if you think about our sector overweights and underweights, we do have a little bit of a tilt towards value. We have a little bit of a tilt towards defensive. But on the defensive side, we've got an overweight to healthcare, which tends to be a little growthier. And we've also got an overweight to utilities, which tends to be a little bit more value oriented. If you think about some of my market weights, we're actually neutral, all three of the big growth sectors, tech, comm, services, and also consumer discretionary. And I think you really don't want to go underweight those areas. I do think it makes sense to pull back on them a little bit, to trim, to add more to the value and cyclical part of the markets. But at the same time, I do think underweighting them could be pretty dangerous.
When you look around the world, we're going to deal with some other global stories this morning, which is China stimulus, which is about blockages in the Red Sea, the risk of divert and freight rates rising. Within an American construct, within the U.S. equity construct, are any of those a material headwind?
So So I think we always care about the inflation story, right? I think a lot of the repositioning we saw at the end of last year, a lot of our calls, frankly, and I think a lot of the calls around the street hinge upon the idea that the Fed will start to cut later this year. And for the Fed to cut, you do need the inflation story to cooperate. I don't think the Fed is going to be that forgiving if inflation rears its head again. They view that as really the central part of their job right now, and they're not wrong about that. So I do think we have to keep quite a close eye on that. I do think the China story is quite interesting. We haven't really had too many conversations with people about China. It felt like a very, very crowded trade on the long side this time a year ago. But money flows did improve when we looked at China at the end of last year. And now it feels like, the narrative is starting to change there just a little bit. So we're watching that one very, very closely because I do think laggards have generally been interesting to people recently.
Okay, you're the first one in a while that's actually it suggested that maybe it is time to review the positioning on China. Laurie, thank you very much. Laurie Calvasina, my guest on the markets this morning. Coming up on the show, the U.S. mounts a response to a drone attack killing 3 soldiers at a base camp in Jordan.
I'm not going to telegraph or forecast any potential response from the United States because of this attack, other than to say there will be a response.